Thank you. Now, this course, the objectives of this course, the reason why you are here is because you don't know anything about investing and you want to learn about investing, or maybe you do know something, but you want to consolidate your knowledge. You want to confirm to yourself that you are on track, that what you know is what you should know, or maybe you want to explore other investing opportunities. You've started the journey, but you're not sure if you've covered your bases, if there's more you should be doing. You want to buy your investment instruments. You are tired of other people investing for you. You want to do it yourself. You want to know what your money is doing at different points in time. You want to know where to buy your investments, when to be buying your investment, and what you should be buying. At the end of this course, you will have the understanding of all of these things. You will know what you can buy, stocks, mutual funds, what they mean, what you should be buying because of your kind of person, when you should be buying it, what your portfolio should look like for you, how frequently you should be buying or you should be shopping for investment, and how to go forward to build wealth during this journey. I will use my own experiences as examples for you along the way. I will talk about what I know, I will talk about my experiences, and I will try to make it as relatable as possible. Any questions so far? Good. Now, what this course is not about, this course is not for budgeting. It's not a saving course. It's not a course to reduce your debt or to talk about reducing your debt. It's not a debt management course. It's not a course that you're meant to use to decide whether you should be saving or investing. You are here because you are already saving and investing. Thank you from Layo Taiwo and Tunde for joining the class. Okay, we have a complete room now. This course is strictly for educational purposes. It is not financial advice and should not be treated as such. So everything you hear in this course is scenarios. If I tell you what I'm investing in or what I've invested in, it is not an opportunity for you to quickly take a paper, write it, and go and buy it tomorrow morning, because it might not be the right time to buy that thing. The financial market is volatile. I have to tell you about it. There are risks to investing. Your investments may grow or they may fall. They may fall below their purchase values. And again, I will tell you the things that I've bought that have fallen below their purchase values. And I will tell you the things that I've bought that have gone exponential. Please do your research before investing. And you are also free to speak to a financial advisor before investing. This is not a cult. This is not something that is a secret that you... Yeah, Mom. Please feel free to talk to your financial advisor or your banker about investing before or after you start this journey. Good morning from Taiwo. Thank you for joining the class. Good morning to the Karen for joining the class. Now, who is this course for? It's for anyone who's interested in managing their money confidently. You want to build knowledge of investing. You want to buy and hold investments. You want to improve your financial knowledge. You know, when you go to those barbecues and boys are talking about trading and they're talking about investment and they're giving you lamba. You want to be able to tell them that no, that's not how it works. In the UK, this is how it works. In the US, Baba, that's not how it works. Because sometimes I listen to those conversations and I'm laughing and I'm smiling. And when they start the lamba, when they see me coming, they keep quiet because they want me to go before they continue their lamba so that I don't come and tell them, chief, don't be like that too. Most of the time I just indulge because me, I'm just there to eat chicken and barbecue meat. So I allow you to do your thing. So this course is to help you have that knowledge. Also, it helps you to be protected from fraudulent investment schemes so that people don't come to you in future to sell you what is not, and they don't come and sell you snow in winter, because you know what you should be doing. You have started your journey, you are focused on it, you have a plan, and you are going forward with that plan. So nobody's going to come along the way later on and start telling you about, oh, they are started selling property in the Pacific Ocean and they are going to pour sand inside and build houses and you should come and buy. You don't need any prior qualification for this course. I've had doctors, nurses, teachers, all sorts of people in this course. I've had plumbers, I've had electricians, I've had people who stopped maths when they were 14 and they've still gone on to understand this course. So please rest assured, you will understand this course. If I get to a point where I'm saying something you don't get or I'm using abbreviations you don't understand, which I try to avoid, please stop me, pull me back and ask me your questions. So, question number 1. What is investing? Who is going to tell me what investing is? Ha! Nobody's answering me again.
I think investing is seeing I mean, seeing a particular thing that maybe you can't own, but you want to be a part of it.
Okay.
But it's going to require your finance. There's a bigger picture. You don't, you can't take the whole thing, but maybe you can take the quarter out of it. That's what I think see as investment, man.
Okay.
And put your
Anybody
money
else?
there for it to grow.
You are trying to grow your money.
Yes, so
Okay. That's investing. Okay, who else? I'm going to need a few answers.
Okay.
I
Okay.
would investing is buying assets and just with the aim of making money over a period of 5 years, 10 years, not now but in the future.
Okay. Anybody else? Do I need to start calling names?
Yeah. Can I go ahead?
Yes, please.
Yeah. Good morning, everyone. My name is Fumi Taro. In a simple and layman's term, investment is equals to savings, or can be termed as savings.
Okay.
That's how I get to know it as an economist.
Okay.
Yeah.
Anyone?
My name is Muyiwa. I would say investment is pretty much maybe continuing from what Fumita said, says more or less increasing your savings, in the future. Like savings you have, but you want to just increase the value of that savings over a period of time, pretty much.
Olusheye.
Okay, yeah. Let me give it a shot. So good morning, everyone. Good morning, Auntie Ronke. Investment to me is like you have money and then you want your money to work for you. It's more like you are allocating the money to do a lot of things for you with the hope of making profits and then cashing out in life.
Does anybody else want to go?
Yeah.
Yes. Go on.
Investment is basically exploring potentials in benefiting from your money or money to increase the value or for a return anyway.
For a return. Yori?
Is it taking maybe calculated guess or risk with your money and hoping that you would gain something?
Okay. Anyone else?
This is Kenny.
Kenny, yeah.
Investment is putting your resources into something for you to make profit out of it or for it to grow.
Okay. Anyone else? Okay.
Hello?
Yes.
Okay. Investment to me is more or less like getting value for resources that are precious to me.
Okay.
Yeah.
Okay, thank you. So the interesting thing is that you are all right. All of you have at some point touched on what investing is. The first thing about investing that I want you to hold on to, the first criteria, is that investing is growing your money. So anything that you put your money into that doesn't grow that money, it's not an investment. And that is why I start out fighting. When I come out and I say your Mercedes-Benz or your BMW is not an investment, and then they start fighting. Or when I say, oh, your house renovation is not an investment, and we'll come back to things that are not investments later on. And that's because by the definition itself, investing needs to grow your money. The plan has to be, like Yori said, hoping to grow what you have put in, taking calculated risk to grow your money. You want to grow your money. That's the first thing. Secondly, investing makes your money work for you, which means even when you are not there, even when you are not actively in the room, your money needs to be growing. You cannot be holding the hand of your money while it's growing. It needs to do the growth without you. And investing can also allow you to have entrepreneurial ownership. But the primary definition of investing is that it needs to grow your money. And I want you to hold on to that first definition because it must become your litmus test every time you want to call something an investment. Every time they bring you that set of pots that they say lives forever. You know that set of, they are smiling. Who have seen that pot? That set of pots that they will come to you and say 10 pots, 10,000 pounds, you will use it forever. will your money grow? Will that money that I'm putting on the pot, will it grow? When I sell that pot, will I get 12,000 pounds? If the answer is not yes, it's not an investment. So investing is like planting. Think of it like putting your seeds in the ground and waiting for it to grow. When you put your seed in the ground, or when the farmer plants a seed, the farmer's intention or hope is not to come back and harvest one seed, even though he has put in one seed, right? The farmer has taken a calculated risk by not throwing that groundnut into his mouth or swallowing that seed or grinding that seed up and cooking it. But he has taken a calculated risk by putting that seed in the ground. He expects multiple seeds, multiple fruits from that seed. So your hope when you invest is to grow your money. Now, I can't remember who said you need to do it for 4 or 5 years. You need to put that money in, expect it over a 4 or 5 year period. Yes. When you plant your seed in the ground, you don't sit down beside it and say, by tomorrow morning, I shall have 10 apples I planted today and water it this evening. By the sun will come out at 7 a.m. and then by 12 noon, you don't do that. You don't come back after a day and expect results. You give it time. And as a good farmer, you will know that, oh, I need to give this particular one 3 months. I need to give it 6 months. I need to give it a year. Investing is like that as well. It needs time. When my daughter was in pre-reception, I think, they gave them seeds. I think it was year 1. They gave them seeds to go and plant in their at home and then watch it over a period of time and then take pictures and watch it grow and all of that. And my daughter happily, we gave her a little pot. She planted her seed. And everybody watered it. And we all watered it. We were happy. We took the picture of the little pot. And the plan was to come back after 5 or 6 days and keep taking pictures. But the next morning, I woke up and I found my daughter with a little shovel. He was digging up the seed. And I said, Auntie, why are you digging up the seed? She said, I want to see how much growing it has done. Some of you are like that. Some of you are like that. The moment you invest, put the money in, by Monday, by Friday, you are withdrawing the money. You are checking to see how much your money has grown. We will go to those habits later on. But investing is about giving your money time to grow, taking calculated risk with your money by putting it in assets that will allow you to grow over a period of time. And some of those assets will give you ownership of a small piece of business. When the business does well, the value of your stock increases as well. Now, why should you bother? Why should you invest? You can put your money in your bank where they're paying you 1% interest or 2% and just chill because life is short. Why should you bother with investing? Because you want to beat inflation. That's the first reason to invest. Some people think you are investing for old age. Oh, I'm investing for old age only. We are not going to be here forever, so I don't need to invest. No, old age is not the only reason why you invest. You invest to hold on to the money that you have worked hard for. You've worked hard. They paid you 2,000 pounds. You have that 2,000 pounds. If you don't invest it, by next year, inflation will have eaten out of it. And what do I mean by that? Inflation is when the value of your money drops over time. And I'll give you an example. In 2007, you could buy a house in the UK if you had £5,000 deposit. You could buy a pretty nice house, because houses were dead cheap, maybe in Kent or in Essex. You get a decent house for your £5,000. In fact, there was a time when you could have £1,000 deposit and you would get a house. 2007, I remember very clearly that you could do that. Now, if you take that same £5,000 now to your estate agent and point at the same house that you could buy in 2007 and ask tell your estate agent that you have £5,000, you want to buy that house, they're going to ask you if you are okay in your head, if everything is well at home. Because that £5,000 does not have that value anymore. Why? Because inflation has caught up with it. So when you invest your money, you are helping your money stay ahead of inflation. So that when inflation is putting percentages, reducing the value of cash, your money is increasing in value and at the minimum, staying ahead of inflation. The second reason is that you can use it to build wealth. If you put your money into stocks or bonds or real estate, you have the potential to not only build inflation, but to grow wealth. If you put your money into real estate, as the real estate is increasing in value because of inflation that is reducing the value of cash, your own money is increasing in value because you have given it to something, you have put it to something that is increasing in value. So you grow wealth. Income, you can get passive income. Investments can give you income. Dividend-paying stocks will give you income. Rental property will give you income. Bonds will give you income. They generate passive income that you can use to supplement your income. And if you invest enough, your passive income can become the only income you need to live on. And that's why some people join the FIRE movement. I'm a big fan of the FIRE movement. And it's something about independence, retiring early. You know, you save and invest so that you can retire early. And it's because they found a number, the amount you need to have that allows you to live completely on your passive income. And I already know my own number. I know because I know how much I need to survive every month. And I'm thinking if I have this amount every month, I'll be fine. And but for me to have that amount in passive income, I need to have this amount in investment. So you can make passive income from your investment. You can also use investments to hit financial goals. You can put money in there are accounts you can put money in the UK that will help you towards buying a house. There are investments you can make in the UK that will help you to buy a house. There are investments you can make that will help you to pay for your children's school fees, to fund their education, to travel the world, to retire early, whether you're in the UK, the US, or Canada. Which reminds me, a lot of people in this session are from the UK. I know I have somebody from Canada. Do I have anybody from any other country apart from UK and Canada? Do I have anyone? No? Okay, so it's UK and Canada. Super. So investing, you can benefit from it to hit your financial goals. So if you don't know why you should be investing, or if down the lane, along the way, you are losing focus, you are losing motivation, you are hearing too much of YOLO, and you won't even know self, this life self, remind yourself of the 4 reasons why you should be investing: inflation, income, wealth building, and hitting those financial goals. Any questions before I move on? No? Fantastic. Do we need a break, or can I keep going? Keep going. Okay. So, to the crux of the matter, to the reason why we are here, how do you start investing? This is the question I get in my DM the most. It's also my favorite question because it's the one I can answer easily. And if you're here, you probably asked me the question and I've sent you a long message. These are the steps, step 1, step 2. Some of you read the step and said, I will come back later. And some of you read the step and said, okay, you know what? Let me book into the class. I can't do this. So I'm going to break this down for you into very simple steps. And then we are going to take the steps together in class today. As much as we can, we will take the steps together. Now, these are the steps. There are 6 steps. We are going to go through each of these key steps. These are the 6 steps you need to take to be an investor. You choose an investment platform. We're going to talk about those platforms today. What platforms are they? What do I mean by investment platforms? What can they do for you? What can you buy on there? We open a tax-efficient account because in the UK, in Canada, tax is not a joke. We don't want to pay more tax than we absolutely have to. And we're going to find legal tax-efficient accounts that allow us to invest without paying more tax. Then we are going to look at a different kind of assets. Now that you've chosen your platform, you've opened your tax-efficient account, what are the assets you can actually buy? And then we will choose your preferred asset. You look at it and say, okay, I'm going for bonds, I'm going for stocks, I'm going to go and think about it. Then you place your order and you rinse and repeat like that. Are we happy with the steps so far? Are the steps making sense to all of us?
Yes.
Good. So we're going to go to the first step, which is choosing an investment platform. What is an investment platform? When I say investment platform, what do I mean? Now, think of an investment platform as a Tesco or a Sainsbury. It's a supermarket where you and I, as investors, can buy our investments, but we can also sell our investments. We can even hold our investment there. Now, when I said think of them as Tesco, I want you to think of it as a place where you can buy different investments, different brands, different products, different aisles, different kinds of investments. So you want to go there, you want to buy clothing, it's Tesco clothing. If you want to go and buy food and you want to buy toiletries, it's there as well. There is a pharmacy, it's there as well. So there are different kinds of investment that you can buy at a fund supermarket or an investment platform. Now, they are designed for execution only. What does that mean? It means when you enter your investment platform, you will carry your shopping basket or your trolley and choose your own investments. Of course, there are attendants there to help you if you get stuck at the point of payment, if you get stuck at choosing something, if you can't find something in an aisle. There are attendants in Tesco to help you. But do those attendants follow you around to choose your shopping? No. Do they follow you around saying, buy milk? You have to buy noodles. No eggs, no eggs. You know, you're always fatty. Don't eat eggs. They don't do that. They let you choose your own shopping. You come in with your shopping list if you have one. You do your shopping. You go to detail. As much as possible, you do it by yourself. If you get stuck, you get help. Now, fund supermarkets are exactly like that. You register. You choose your tax-efficient account. You choose your investment, you connect it with your bank account, you start shopping. You either do it as a direct debit or you do it as whenever I'm ready kind of thing. If you don't get stuck, they don't reach out to you. You don't reach out to them. Of course, the platforms also provide tools to help you. They provide information to help you. But the whole idea is to give you easy access to investment opportunities. In the old days, investing was a thing that rich people did. If you were an investor, you were either rich or you were in the financial services. Those were the only kind of people who really did investing. When I was growing up, I grew up with an investment banker. My dad is a retired investment banker, and they would invest, and it was like Greek. And it's people would come to the house sometimes to have meetings with him because he needed to explain things to them. And then when I was growing older as well, he had a stockbroker. He would go to the stockbroker with a list. Then he would say there's a call, there's a short, and then you should take a note. He will call on the landline. Then I would take the bus or take a taxi and go to his stockbroker. It was a very clunky process. Not anymore. It's simple. You and I can do it from the comfort of our bedrooms, our laptops, and our tablets, and our phones. They've also provided tax-efficient wrappers so that you don't have to pay extra tax because we're in tax-heavy countries. There are funds at discounted rates. You can switch between funds. You can buy one fund today and switch into another one. There's little or no paperwork. When you register, they might send you a letter confirming that you've opened an account or confirming your identity. That's about it. A lot of them also provide extensive research and information to support your purchases. So if you're not lazy, if you can set aside time to read material, you will not have to message me to say, Ronke, what should I buy? No, because you will know your own needs, your own financial goals, and you will shop according to those goals. Now, there are different kinds of investment platforms. I said earlier that there's this platform you go in, you choose your own stocks, you choose your own assets, you buy, you pay, you go. Execution only, strictly Tesco. And then there are robo-advisors. Robo-advisors use AI. You know, now we have ChatGPT. ChatGPT came in maybe last year or 2 years ago. We are all excited about it. But AI as a language model, as a machine learning model, has been around for years. Robo-advisors use AI to recommend tailored portfolios based on your investment aims and attitude to risk. When you register on a robo-advisor platform like Wealthify or Nutmeg or Wealthsimple, they'll ask you a series of questions: your name, your age, your financial goals, your risk appetite. They want to know your risk tolerance. Your risk tolerance is very important when you invest. Why? If you have low risk tolerance, which means you don't like to lose money at all, there are some things you should never invest in, because when you invest in them and they are volatile and the market moves in a volatile way, you will message me at 2 a.m. You will message me at 2 a.m. and you say, okay, that thing that we bought is not doing well. What should I do now? Because you've invested beyond your capacity. You've gone and followed the crowd. You had what do they call that thing now? FOMO. You had FOMO, and you went and you had fear of missing out, and you went and bought something that you shouldn't buy. So it's very important that you know your risk tolerance. What can you take? There are some of you here, even if your 10,000 pounds becomes 10 pounds, you're like this. God give it, God take it away. Odewumi master, I respect you. When you're like that, you can stocks, you can do this, you can do that. Don't I know I'm not like that? I'm married to somebody who is like that. If I do research and I run spreadsheets, I love researching investments, and I run the spreadsheet. I love the numbers. I run the numbers. And I say to my husband, this particular thing is going to grow. It's going to grow. I'm thinking, I'm still talking. Baba has bought 3,000 pounds. Spending. After doing the research, after doing all of that spreadsheet, I will spend 500 pounds. Why? Because my risk appetite is low. Because I don't like to lose money. So I always invest money that, if this thing collapses, it's just 500 pounds. And then sometimes that research I've done, other analysts have not mentioned it. I will go online and nobody's talking about it. I will not say, am I smarter than all the other analysts? No. So I must be wrong. And then 6 months' time, my husband is cashing out. And then I'm looking at it, I say, you don't trust yourself. That's why. You don't trust, but it's a risk appetite thing. It has everything to do with risk tolerance. So you need to be aware of your risk tolerance. And these robo-advisors will always want to know your risk tolerance. They will ask you those questions. And then once they know your risk tolerance, they will suggest a portfolio for you. Now, the thing about these things is that it's fully automated. They are managing the portfolio. They do everything for you. You cannot manage your own portfolio. You cannot choose your stocks. You cannot come back and say, hey, that something is going well and you want to buy. You don't get that choice. They choose for you. And then every year or every 2 years, they will come back and check your risk tolerance again to make sure that things have not changed. Now, when I first started using robo-advisors about 8, 9 years ago, I wasn't very trusting because I felt like AI was new and, who knows about these things? Technology will fail. They will come now and say, oh, this is that. So what did I do? I opened one robo-advisor account for one of my children, and I opened a regular investing account for the other one, and I started putting in equal amounts of money. And for one, I will choose the investment, and for the other one, I will allow the robo-advisor will go ahead and choose the investment, and I will make sure that I'm putting in the money on the same day. So it's equal opportunity. There's no different benefits to it, and all of that. And I started doing that, and in the first few years, my investments were doing better. And so I was going around with my shoulder pad like this and saying, the robo-advisor is performing, but even computer is not doing it well. It doesn't know the nuances of the market and all of that. And then COVID came. But when COVID came, I had a smaller picture of COVID. The AI was able to maybe troll the news. Maybe he had a better picture of COVID. I don't know. He moved things around. I was slower at moving things around. I was more focused on whether do we need tissue? Are we safe? Do I need to do I need to stay indoors? Do I need to go? I was distracted by everything else, and I was not on top of my portfolio as much as AI. And what happened? My portfolio started performing a little bit worse while the AI was performing better. Until today, now my portfolio has caught up, but the AI has not failed. That's the honest truth. 8 years and it has done excellently. So I can confirm to you that if you are somebody who doesn't want to choose your own investment, if you are somebody who doesn't want to just think about specific stocks and assets and you don't want to be involved in all of that, robo-advisors are an option for you. I use Nutmeg. For the UK is great. For Canada, I think is Wealthify and Wealthsimple. There's Money Farm as well in the UK, very popular. All of these platforms can help you to invest your money. So you really have no excuse. You cannot come and say, I've not invested because I didn't know what to buy. Let somebody else do it for you. You can use robo-advisors. Now, even with investing platforms, they have ready-made portfolios. A lot of these platforms, and I'm going to take you through them, they have ready-made portfolios where you don't still have to choose. If you're somebody who doesn't still want to choose your assets, you can go for their ready-made portfolios that they've built for you based on different attributes as well. And in those portfolios, you can see what is in it. This one is not like robo-advisor that's not showing you what's in it. You can see what's in it and choose a ready-made portfolio on an investing platform. Now, how do you decide which platform to go for? Because there are so many. You need to think about the fees. That's the first thing. One of my favorite platforms is also one of the most expensive platforms you can use, Lansdowne. I stopped recommending it simply because of the fees. Not because it's not good, not because its services are poor, but simply because I found out that not everybody is as comfortable with the fees as I am. So you need to think about fees. You also need to think about the range of products that the platform offers. Some platforms offer everything. Stocks, bonds, mutual funds, ETFs. Lansdowne is the king of that. They offer everything. In fact, a lot of times, if I can't find something on Agriz, I really need to think hard about who else is going to sell it to me in the UK. So there are platforms like that. And there are platforms like Vanguard. Vanguard sells only its own product. Think of you going to Tesco and finding only Tesco Essential and Tesco Premium. That's it. No Johnson & Johnson, no Pfizer's, no any of those nice brands that you can think of to buy for your food or your toiletries is Tesco only. So that's what Vanguard does. The fortunate thing about it is that Vanguard products are super good. They perform well. They have low fees. They have a good historical performance. So it's not as if you are getting low quality products. It just means you are getting Vanguard products. So you need to think about the investment and account options. 2212 as well has a limit to some of the things it offers. It sells some things, it doesn't sell some things. And then there's platform security. You need to think about whether your platform is secure. Does it have encryption? Do you have two-factor authentication on your platform? The hackers of this world, they don't mind the heat of hell. They are ready to go there. They are working day and night to break into your account. Don't give it to them. Make sure that you have two-factor authentication on the platform that you are using. If the platform doesn't have that, check out quickly. Don't bother with that platform. Make sure that the platform you have chosen is regulated by a financial body. In the UK, is the FSCS. In Canada, it depends on the province. Some of them have whole Canada protection. Some of them have provincial protection. Please check. They will have it on their website. Now, don't trust their website. Go to the platform of the financial body and type in that company name into their search. They don't have it because some companies will just put it on their website because they are trusting you not to check. They are counting on you to be lazy. Don't trust them. Take that their information to the financial body and let the financial body confirm that they are regulated. In the UK, if an investment platform is regulated, your money is safe up to £85,000. That means if anything happens to that platform, if it crashes, the UK government is responsible to give you back your money up to £85,000. Anything beyond that belongs to the king. So the fund safety is important. Mobile accessibility. Some of us like accessing our money on apps. You want to look at it. Some days when I'm feeling low, I will log into my investment platform and look at my money. I might not have designer clothes, but I have money. I have money. It might not look like it, but I have money. Even when my manager at work is acting funny, I will look at my account and say, it's a matter of time. It's a matter of time. Hey, one day you will see me, one day you will not see me anymore. Some of us like mobile apps. Some of us don't like it. You don't want to check because the day you get there and it is low, you will flog your children. So there is no need for you to have the one that has mobile app. Just gently go and sit with the Vanguard. Vanguard doesn't have mobile apps. They don't want you to be looking at it online. So you want to go to your laptop, you need to log in on your laptop to look at the Vanguard platform or to go on the website. So they don't have an app. So you need to think about whether you want something that has an app. You need to think about whether you want something that has research. Some will give you good research. They will give you what's going on in the market. They will give you news. They will give you articles. AgriLansdown has that. And some of them don't have that. They just want you to go in, go out, do what you want to do and get out. We don't have time for you. Do you want to buy? You're not buying. Bye-bye. Now, if you register on a platform that doesn't provide research, you can still visit the platforms that do provide research to get your research. I love going to Yahoo Finance. I love going to Stocks News. I love going to AgriLansdown page. I have a series of websites that I go to, and I've shared them on my platform before as well. And these are the places I go to when I want to look at what is going on in the market. I think Yahoo Finance is the one place I go every single day. Every single day. My Bible and my Yahoo Finance. Those are the two things I do every single morning. I will check what's going on out there in the world, what's happening. Do I need to mind it or do I need to ignore it? So you need to find out if you want to have that on the platform where you are invested. Now, in the UK, I have made a list of platforms that are regulated. If your platform is not on this list, I cannot confirm if it is regulated. These platforms are the ones that I have checked on the financial services platform, and I know that they are regulated and your money is protected. So as much as possible, you should be using one of these 10 platforms. If you're not using one of these 10 platforms, I don't know. There is Moneybox, it's super popular. I'm aware that it's regulated. I haven't actively checked, but I know that a lot of people are using Moneybox as well. So these are the 10 platforms I have for my people who are in the UK. Before we go web surfing, I wanted to show the platform for Canada. Yes. So for Canada, we have Wealth Simple, Quest Trade, super popular. We have TD Direct Investing. We have Scotia iTrade. These are the platforms that you can use in Canada. I mentioned earlier that they can have overall Canada regulation, but they can also have provincial regulation as well. Okay, guys, do we need a break? All right, so I will give us a little break. We will come back at 11. I'm sorry, at 10. When we come back at 10, we are going to be going online. I'm going to be taking us to these platforms that I've talked about. I will take us to 3 platforms so that we can look at it. I want us to confirm in the chat, those of us who have registered on platforms and what platforms you have registered on. And if you have not registered on the platform, I want you to say not registered. I need 18 answers. There are 18 of you, so I'm going to expect 18 answers. Do that quickly before we log off and take a break. And don't log off before we just go for a break. Yeah. Okay, we're recording again. So you guys can see my screen, right?
Yeah.
Okay. So the first website we're looking at is Agrives Lansdowne. I logged in while you guys were out and I quickly logged out. This is what Agrives looks like. This is the home page. So it's hl.co.uk. Agrives is one platform that provides a lot of information. So let's go through it together. So if you go into Agrives, you want to go for personal, not workplace, because they have workplace programs. You want to go for personal at the top here. That is the automatic thing that will put you on. Just make sure you're on personal. Then you will come here and you will register. Now, no, yeah. So you want to open an account, open an HL account. It will ask you for your account options. Do you want to do stocks and shares ISA, fund and share account, self-invested personal pension, lifetime ISA, active savings, cash ISA? Lots of options. Agrives has everything. But I said to you earlier that we're going to choose a tax-efficient account. Now, we will talk about the different kinds of tax-efficient accounts. We will talk about stocks and shares ISA, self-invested personal pension. We will talk about the lifetime ISA. These are the 3 accounts that you can invest with. The others are savings. Cash ISA is a savings account. You can save up to 20,000. Active savings is a savings account. Accounts for children, we're not talking about those. So we are focusing on stocks and shares ISA, self-invested personal pension, and lifetime ISA. Now, this account here called the fund and share account is not a tax-efficient account. Is an account that if you invest through it, you will pay the full tax on your income from this account. It's an account that's usually used by traders because they need to declare income and they're to set up a company and all that. You don't want to use this account as much as possible unless you have used up your allowance everywhere else. And I will talk about your allowances everywhere else as well. Now, Let's assume that you are going to be investing with a stocks and shares ISA, and you understand that when I talk about the kinds of accounts you are going to be using. The stocks and shares ISA account is the most efficient, most tax-efficient account you can use because it's tax-free, zero tax. So that's the account you are going to open. You are going to open an ISA. Now, to open an ISA, it takes about 10 minutes. You need to have some details about yourself. So log in to open an account. No, what's going on? Open an ISA now. Yes. Yes. So they will ask for your details. You give them your name, date of birth. You need your NI number because that's kind of how they know that you're UK resident. Then you put in your nationality, your email address. I normally try to avoid the multiple nationality thing because they will ask you to provide passports of the different countries, address at the different countries. As much as possible, I always go for UK or non-UK. If you don't have a UK passport, you have a non-UK passport. That's fine. Email address, phone number, house number, postcode. How did you hear about us? You fill it. They will ask you if you want to add money now, if you want to set up monthly payments, or if you want to just set up monthly payments. Now, when you set up monthly payments, it does not mean that you have started investing. You have just put in money there, ready to invest. You have not started investing. So you add money or you set up a monthly payment. If you set up a monthly payment, it's good because it automatically connects to your bank. And now that's sorted. You finish that form, you open your stocks and shares ISA account. That is how you navigate Agri's Lansdowne as a platform. Now, once you've opened your account, which is the stocks and shares ISA, I could have done that straight by just coming on that account, actually, instead of taking you to register. I could have just come here, accounts, ISA, stocks and shares ISA, boom, you open it. Open the stocks and share. So Agri is very intuitive. There are different ways for you to access what you want to access. Now, let's say you've opened your account and you want to invest. Then you have to come and look at the different opportunities for investment. Do you want to buy shares, funds, ETFs, trusts, yields, bonds, stock market data? You want information, you want guides and tools. They have research material here. They have investment ideas. I mentioned to you earlier that they have suggestions on what you can invest in. They have ready-made portfolios. So they have ready-made investments. They have portfolio building blocks. You're unsure where to invest, they will tell you, they'll give you ideas. They have fund range. They also have something called the wealth shortlist. Now, the wealth shortlist are like 40 or 50 companies or funds or assets that these guys have researched and they are comfortable with it. They think that these things will perform well. They've taken them across different sectors, and they have said these are funds suggestions that you can invest in because Agri's Lansdowne's analysis team have reviewed these funds. They've looked at the manager, the culture, the process, the performance, and they have picked funds. And there are just 68 funds that they have picked. And then you can look at the funds and say, what are the ones in Asia? These are the Asia funds. They will come again and tell you about corporate and government bonds, emerging markets, Europe, global funds, and so on. Now, what Agris will not tell you is that a lot of these funds are mutual funds. Their fees are high. They will not tell you that these funds are not ETFs, unless you specifically go and come here and say you want just tracker. If you don't say that, they will show you all their funds, and their funds are mutual funds and they're expensive. But if you say you want just tracker funds, they are down to just 17 funds, as you can see. So there are just a few emerging markets, one Europe fund, and even that Europe fund, the yield is low. The fund charge is still high. It's still 2 numbers. So generally, their wealth shortlist for me is like a rich people shortlist. But they have the shortlist and you can access it. Then, if you also go back here, you can just ask for their ETFs. Now, with ETFs, these are exchange-traded funds. I talk about this a lot on my platform. These are the cheap ones. They are a basket of funds that you can invest in, and I will explain later on in detail. But these are the list of ETFs that they have. You can type in an ETF and you can search for it. One of my favorite ETFs is the Swida. You can search for it here, and they will tell you whether they have it or not. And yes, they do. They have the SWIDA, which is the core MSI World ETF. It's an ETF that I like a lot. And one of the reasons I like it a lot, you can see the trajectory of this ETF in just 1 year. If you look at it in 5 years, you can see the growth is sure. In 10 years, it just keeps growing. It's not an ETF that is messing me about. So it's an ETF that I particularly like to invest in. So if I have money and I don't want to do research and I want to invest in something very quickly, I will normally go for a SWIDA because it's highly diversified. Look at the companies that is invested in. It automatically invests me in all of these companies and is invested across sectors, invested across the world. I love SWIDA. But anyway, that is how you invest on Agris Lansdowne. The account you want to go for as a tax-efficient account is a stocks and shares ISA. The lifetime ISA is an option if you are below the age of 40 and you're trying to get on the property ladder. But I'm jumping the gun. I will come back to that later. Now, let's look at free trade because I know somebody's registered on free trade as well. On free trade, you are going to try and look for the same tax-efficient account. At all times, you are looking for a tax-efficient account. They've come here to tell you that they also have the stocks ISA, the self-invested personal pension. These are the two tax-efficient accounts that they have. The most tax-efficient, again, is the stocks and shares ISA. But for you to have it, you need to choose a plan that's either the standard or the plus. The standard, if you're only using the stocks and shares ISA, if you're planning to open a pension account here, you can use the plus. Avoid this GIA account. This general investment account is the same thing as the fund and share account here. Fund and share account in Agris is the same thing as the general investment account. It is fully taxed. If you go on Vanguard platform, they also offer accounts. You want to come and look at the Vanguard ISA account. The Vanguard general account, again, is the one you want to avoid. Once they start putting general into it, basic, you want to avoid it. It's taxed. Now, if you come to Vanguard, you are looking for the Vanguard ISA account. Now, with the Vanguard ISA account is also a stocks and shares ISA account. I don't know why they didn't put stocks and shares in the name, but that is the account you want to look for if you go on Vanguard. You should go on Trading 212 as well, and you click on the invest button at the top. Open an account. I don't like this platform very much. Yes. So they will ask you to choose an account. You choose an investing account, not the CFD, because you are not a trader. We choose the investing account, you will then register here. Now, the problem with Trading 212 is that the fact that they've told you that you chose an investing account does not mean that you've chosen the stocks and shares ISA account. So make sure that once you are registered, you are choosing their stocks and shares ISA account. The reason why I generally stay away from Trading 212 and this kind of platforms is because they push trading a lot and it's very distracting for me. Now, if we go to Canada, Wealthsimple is a very good platform for investing in Canada. Like I said before, you can go for managed investing where they've chosen your portfolio. There's already a dedicated portfolio for you. Please go for classical in this case. Socially responsible portfolio. You are looking at ESG. You are looking at environmentally friendly. Their returns are usually poor, because you will be excluded from a lot of companies, because a lot of companies are not well behaved enough to qualify as socially responsible. So you need to decide if you want to be socially responsible, if you want to make money. I'm not saying you should not be socially responsible, but if you want to be socially responsible, be ready for low returns. You're saving the world. God bless you as you do so. So managed investing, think about that. Then if you want to go for self-directed investing, which is what our own interest is, you want to do stocks and shares, you have options trading. The account type you want to go for. The tax-efficient account for Canadians is registered retirement savings plan or the tax-free savings account. In this case, we are going to focus on the tax-free savings account because that's the one you can invest in with money that you have after you have collected your salary or after you have made your income. So tax-free savings account is what you want to go for when you register on a platform like Wealthsimple. Now, we are going to go back to our slides and look at those tax-efficient accounts and why I am saying they are tax efficient. Why should you choose them? What do I mean by tax efficient account? Why can't you just choose the GIA one? It's your money. Okay. Now, tax efficient accounts. The reason why I'm asking you to choose tax efficient account is because it's tax-free investing. So whatever you put in and whatever you get out is all yours. It's tax-free. If in the UK, this is the UK now, you go for the stocks and shares ISA, you have a £20,000 allowance every year. The financial year starts on the 6th of April. It's not January 1, it's the 6th of April. That's when the financial year starts. And when that year starts, your £20,000 starts to count. My apologies. Your £20,000 starts to count. And that £20,000 is not available to you on just the stocks and shares ISA. It's available to you across stocks and shares ISA, cash ISA, and LISA, which is the lifetime ISA. So if you open 3 ISAs, so if you open a stocks and shares ISA for the purpose of investing, and you put £5,000 in it, tax-free money, that's money that you can now invest tax-free. You put £5,000 in the stocks and shares ISA. It means you only have £15,000 left to spread between a cash ISA and a lifetime ISA if you have those accounts. So if you're below the age of 40, for example, and you still want to have a lifetime ISA, and you put £4,000 into your lifetime ISA, which is the maximum, you only have £16,000 left to spread between your cash ISA and your stocks ISA. Let me repeat that. Your tax allowance annually for your ISA account, which is your individual savings account, is £20,000 between April 6 and April 5. If you don't use it, it doesn't roll over. You start a fresh £20,000 the next April 6. And that is the amount you can invest, save, whatever, per year, tax-free. You can withdraw your money anytime within your allowance. I discourage that as much as possible because when you withdraw it, you don't get to put it back in as a new money. No. If you've used the £20,000 allowance and then you withdraw everything because you want to start afresh, that's your business. You're not starting afresh. You have to wait till April 6 the next year to start. Now, as much as possible, please don't get the idea that nobody is tracking you. You can do 20,000 at Agrips and then sneakily go and do another 5,000 at Vanguard. Orange does not look that good on you. If you go to prison, I will not visit you. So therefore, make sure that you are sticking to the £20,000 allowance that you have. And when your allowance is exhausted, you can then wait till the next year to use your new allowance. Like I said before, it's not that once you go over, oh, you're going to jail. That's not what I'm saying. I'm saying if you make a habit of going over your allowance, you are inviting HMRC into your business. If HMRC has never been in your business, ladies and gentlemen, you don't want them in your business because they will come with their magnifying glass and they will make your life miserable. You wake up one day and you hold them £100,000. You don't want that. So as much as possible, stay within the lines of the law. You can invest up to 20,000 each year through your stocks and shares ISA. Now let's assume you are below the age of 40. You don't own your house yet. You want to buy a house. One of your financial goals is to get on the property ladder in the UK. Fantastic. What you want to open is a lifetime ISA account. Now, with a lifetime ISA account, unlike the stocks and shares ISA, you are guaranteed 25% return on your money. Why? Because the UK government is giving you 25% on your money that you put in, which is why they limit it to £4,000. Otherwise, even I would just put my money into that lifetime ISA and rest. I'm not bothered with stock and shares ISA because what am I investing in that will give me 25%? But with this one, you get 25% because they're trying to help you to get on the property ladder. So you put in 4,000 every year, the government will add 1,000 free money. Now, don't get the idea that if you put in 4,000, they add 1,000, you do that for 3 years, you just wake up one day and say, it's my money. I'm not buying property again. I'm going back to Nigeria, and you will withdraw your money. They will collect that £3,000 back. Please don't be confused. They will collect that money back with interest. So if you put money into your lifetime ISA, you should not be withdrawing it. There will be penalties for that, which is the interest they've given you and any other interest they think the money has made. So you putting money into your lifetime ISA is always a good idea. If you are going to buy property within a year or 2, don't do the stocks and shares lifetime ISA. Do the cash lifetime ISA. So if you're planning to buy, if you already have money saved and you know that, oh, I just need to add extra 12,000 to my property goals to get money, or I need an extra 15,000, and then in 2 or 3 years, I'm going to buy property, then you definitely need to be opening a cash lifetime ISA, not a stocks and shares lifetime ISA. With a cash lifetime ISA, all you are going to get is the extra £1,000 from the government. Now, if you open a stocks and shares lifetime ISA, let's say you're over 40, but you have an 18-year-old, you want them to get on the property ladder at some point, and you want them to get the full benefit of that money. You are going to open a lifetime ISA for them when they are 18. You're going to put in £4,000 for them. The government will add in 1,000 every year until your child is ready to get on the property ladder. Then they will be able to use the whole money to get on the ladder. And for those people, you can open a stocks and shares lifetime ISA, because in addition to the government's 1,000, their £4,000 is being invested. You can invest that £4,000 and still make money on the stock market in addition to the government's bonus. So it's a kind of a double bonus you are getting if you do a stocks and shares lifetime ISA. Now, if you are somebody who put 40 money into your lifetime ISA before the age of 40, you can only open it before the age of 40. You've bought your property with your money. You've done the withdrawal, which you can only do through your conveyancing lawyer. You can't withdraw the cash. They will penalize you. They will assume that you're just taking out the money. You're not buying property. But if you're buying property with it, money is meant to go through your lawyer to the mortgage provider. You've done it, but you still have the account. You can keep using it to invest. And the UK government will keep adding 25% to your money until you are 50. Then they will stop adding to it. And then for 10 years, they will not add anything to that money for you, which you can then withdraw at the age of 60. The thing with the lifetime ISA is that once you've bought property, any money you put into it after that, you cannot withdraw until you are 60. If you withdraw before 60, you will be penalized for that withdrawal. So that's the thing with the lifetime ISA. Remember, the lifetime ISA is also part of your ISA allowance. You are using your ISA allowance when you use it, but I think it's a fantastic thing. Unfortunately, I had gotten on the property ladder before the lifetime ISA was introduced, and so I could not take advantage of the lifetime ISA, but I think lifetime ISA is a fantastic opportunity for anyone who is willing to go on to retirement because of the 25% that the government is throwing on top of that money for you. It's really good, low-risk way to grow money. Now, in addition to these two options, you also have the self-invested personal pension. This one is not as tax efficient as the stocks and shares ISA because it's not tax-free, but you get UK government tax relief. So you can use it as part of your pension allowance. You can use it to save extra pension. You can use it if you're a contractor who doesn't get pension from workplace and you want to open your own pension, because your company can pay into it. Your company can pay it's limitless. Your company can pay as much as it likes into this account for you. And you can also pay up to £40,000 into it. The only thing is that it will be taxed at the point of withdrawal. When you are 55, it's going to be 57 from 2028. So for most of us, that's 57. You can then withdraw money from it, and it will be taxed at whatever rate you are operating at then, which is likely to be a basic rate because you are a retiree. You can have this in addition to your existing pensions. So it's not something that you cannot have alongside other pensions. You can have it alongside your workplace pension or any other private pension that you have. Kende, you have a question.
Oh, yes, I do.
Yes.
Yes. Oh, I don't want you to go far before I ask the question. It's regarding opening a lifetime ISA account for the kids. You did say that if we put in 4,000, the government will give us 1,000. Then you now said if we then use the 4,000 to open stock and shares lifetime ISA. So that's a bit confusing. So is it the same 4,000 that we are rolling into the stock and shares lifetime ISA, or we are using another 4,000 to open a stock and shares lifetime ISA for them?
Thank you for that question. That's a really good question. Now, the money you put into your stocks and shares ISA, the limit is 4,000. You can only have one, either the cash or the stocks and shares ISA. So the ISA account, you can have a cash lifetime ISA or a stocks lifetime ISA. You can only have one. Each person can only have one. So your child, who is between the ages of 18 and 39, can have a cash ISA or a stocks and shares ISA. Whichever one they have, their limit is £4,000. So you cannot have 4,000 in cash LISA and have another 4,000 in stock LISA. No. The government will only pay into one LISA for you. So if you open a lifetime ISA, if a cash ISA or a stocks and shares ISA, LISA, the government will pay into that. Then in addition to a lifetime ISA, you can have a stocks and shares ISA. So you can have a stocks and shares ISA and a stocks and shares lifetime ISA. Or you can have a stocks and shares ISA and a cash LISA. You can only have one kind of LISA. You can have a stocks and shares ISA. You can have a cash ISA. Whatever you have across all three cannot exceed £20,000 in any financial year. Do you understand?
Yes, I do. So the difference is the lifetime that is in it. Because even for myself, I could have mistakenly gone to the stock and share lifetime ISA to invest instead of the stock and shares ISA.
Yes, but you see, with the lifetime ISA, they will ask you your age, date of birth. So once you put in your date of birth and it's over 40, they will tell you that you're not qualified for that account.
Okay.
Yes, usually most platforms will tell you that you are not qualified to open the lifetime ISA once you are over the age of 40. They have a barrier that will prevent you from opening the lifetime ISA for yourself if you are over the age of 40. So now we know the three tax efficient accounts that you can have in the UK. You can have the stocks and shares ISA, which is the most tax efficient account that you can have because zero tax. You can have the lifetime ISA, which is also the most tax efficient account if you are below the age of 40, except that it has a £4,000 limit and you can't withdraw it anyhow. It's not that flexible, while the stock and share ISA is super flexible. You can withdraw it anytime you like. And then you have the self-invested personal pension account, which is an addition to these two accounts that you can have and you can invest in. What am I doing? Yes, that you can invest in. Now, for the Canada guys, I mentioned earlier that the tax efficient account in Canada is the TFSA. That's the tax-free savings account. Very similar to the stocks and shares ISA. You can use it to buy stocks, bonds, mutual funds, GICs. You don't pay any tax on your income or capital gains earned within the account. The contribution limit for 2024 is Canadian dollars $7,000. So it's quite low, with a cumulative maximum for individuals. So that has been registered. So unlike stocks and shares ISA, there is a carryover opportunity here. While in the UK, there is no carryover. You don't use it, you lose it. While in Canada, you can carry it over. Maybe that is why the value is low, So there is a maximum of 103,500 as of 2024 for you. Any unused contribution, you carry forward. You can withdraw it anytime, just like the stocks ISA is tax-free. And if you withdraw something, you can recontribute in the following calendar year. Why? You guys are having a good time. We can't do that in the UK. It's available to everybody over the age of 18, and it's great for investing for short term or supplementing your retirement savings. So if you have specific financial goals, you can use this. If you want to add to your retirement savings, you can use this as well. There's somebody with a hand up, Olu Williams.
Yeah, sorry, taking you back a little bit, if that's okay. For the SIP one, I just wanted to ask if it's got any impact on the personal allowance that, if you earn over 100K, please correct me if I'm wrong, you begin to lose like £1 for every £2 or something like that.
Yeah.
Does that have any impact on because it will take the overall income down to maybe under 100K, something like that? Does that have impact on that?
This actually helps in the sense that you get the UK government tax relief. So with this SIP, you can apply for additional tax relief and get money back. So the best way for people who earn over £100,000 to save money or to reduce their tax is through their pension. Usually you can max out your workplace pension, but you can also apply for additional tax relief with your self-invested personal pension. Does that make sense?
Yes, thank you.
Okay. Doing.
Yeah, I have got a similar question. I don't know if you might not be too familiar with it, but my question is it a good idea for someone to take the 25% out of this SIPP when they turn 55 or 57, regardless? Do you think it's a good idea or no?
The 25% is tax-free.
Yeah.
So I will take it out because what you can then spread the spending over a period of time, or put it into bonds, or put it into something that you can then access it. The danger of that is that you can be targeted by people who know that you have now retired and you have some bulk money and they can take it off you. You can also be tempted to spend anyhow, because when you take 25% of 500,000 pounds, it's a lot of money. Suddenly you are this person that has cash and, oh, I want to buy a house for this person, I want to help this person. Before you know it, is all gone. But the 25%, you can also stagger the withdrawal, because once you start withdrawing, they peg it and they're aware that you have started withdrawing. So it's only the first 25% that is tax-free. It does not mean that you have to take it out in one go.
Yeah, okay. But in a way, if you're ready to reinvest it, it's a good idea.
Yes, but I will be very wary of aggressive investing at 55, because if you take it out, you can put it into your stocks and shares ISA because it's tax-free. You can put it into your stocks and shares ISA, into something that is not too aggressive, and then you can reinvest like that. But remember, the stocks and shares ISA has a 20,000 pound limit.
Yeah.
So if your 25% is more than that, then you have to wait till the next year to put in another 20,000 and go on like that.
Well, but if you look at it this way,
yeah.
Sorry guys, if you take some lump sum out, I believe in property or things like that, then if you go and reinvest it in a property, you end up making more money than leaving it in your pension,
yes,
isn't it?
Absolutely, you do. But again, that has a lot to do with your risk tolerance. If you are able to tolerate that level of risk, absolutely. And then for somebody who is probably a property investor already, and you want to take out the money and put into it, you can do that. Just be aware that you have now removed the money from tax-free.
Yeah.
Because once you go to put it in, you invest it, it will pay full tax.
Yeah. Okay, thank you.
You're welcome. Any other questions before we go on? No? Okay. So I was talking about Canada and the tax-free savings account that you have in Canada. And in addition to this tax-free savings account, which is very similar to the stocks and shares ISA, you also have the registered retirement savings plan, which is very similar to the self-invested personal pension I talked about. In fact, it's more similar to like a workplace pension. And this one is tax deductible as well, because it reduces your yearly taxable income. You get tax relief on it. You only pay tax on it at withdrawal, which again is very similar to the UK retirement system. At that point, you are likely to be in a lower tax bracket, so tax will be low. They don't have the 25% free portion like the UK. You pay tax on everything. The annual contribution is 18% of what you earned last year, up to 31%, 31,560. So your annual contribution this year is very dependent on what you earned last year, and whatever you didn't use can then be carried forward into the next year. It's taxed as ordinary income. You can use this to get on the property ladder. So you can withdraw funds from this one if you are using it as part of a home buyer plan or lifelong learning plan. So if you wanted to go back to school or you wanted to get on the property ladder, you can make withdrawals from your RRSP, and then you can repay the amount within an agreed period of time, and you won't get any tax penalty for that. So this one is also available to all Canadians over the age of 18 who earn income and do returns on their income. Oluseyi has a question.
Thank you. Yeah, sorry, not a direct question. I wouldn't mind if you can just go through the SIPP again, please.
I can't hear you. I can't hear you.
Okay, just a minute.
Yeah.
Yes, can you hear me now?
Yes.
Hello?
I can hear you now.
Okay, thank you. I said not a direct question, but I will appreciate if you can just go to the SIPP for the UK once again, please. Sorry for taking us back.
I'm happy to do that.
Okay.
Okay. So the self-invested personal pension allows you to make additional investments. into your pension pot. You have an allowance of £40,000. This covers your whole pension allowance, your whole contribution to your pension. So if your workplace, you are already contributing £1,000 monthly or £500 monthly, you are already using part of that allowance. And then the rest of the allowance you can invest through your SIP. Now, the advantage of the SIP is that it's topped up by the government with 20%. So if you put in £100, in fact, if you put in £100 on Vanguard, immediately you will see £20 landing. They will say you now have £120 in your SIP. I've done that. I have a SIP with Vanguard, so I know that's how Vanguard works. I also have a SIP with Lansdowne, and I found out that their own is a bit crazier. The extra doesn't land immediately, and there's a bit of a process, and then it comes in. But it comes in, and then you get that top up from the government. And the difference with this one is that you are the one picking your investment. Unlike your workplace pension, how many of you know what your workplace pension is invested in? Do you know how many units you have in different stocks? Or you don't. You don't. You are trusting somebody to do it. No respect for your risk tolerance, your desire to be rich, your desire to become an odogu. They don't have any respect. They invest it on a universal level for everybody, and it's usually very low risk. So the return on your workplace pension is usually low. There's nothing there. They will just keep chucking the money and chucking the money. If you're a private employee, you get that pension return. And sometimes they will tell you, some employers allow you to even choose your category. I remember I had an employer once that allowed us to choose whether you wanted to be low risk, medium risk, or high risk. They allow you to choose. But beyond that, you don't know much. Now, with your self-invested personal pension, you get to choose what your money is invested in. Now, the thing with the self-invested personal pension, you cannot withdraw from it before the age of 55. Once the money goes in, is in. Until you are 57, for most of us, you cannot withdraw from it. And when it's time to withdraw from it, it will count towards that your 25%, which is free, before you start paying tax on your pension withdrawals. Have I made sense?
Yes, you did. A follow-up question. So in this case now, does it mean we give our employer the details of this to pay the pension into, or how does it work?
No. So this is your own money after tax that you can invest in. Okay. This is a pension that you can invest in directly from your own account. Now you can also give this account to, your company can invest in it. If you, for example, you're a contractor, you're a self-employed contractor and you have a company, you don't have any other pensions anywhere, your company can invest in your SIP for you. You can make direct transfers from your company account to your SIP. You cannot make transfers. If you make transfers from your company account to your own account to your SIP, you have just paid yourself extra salary that will be taxed. So make sure that the transfer is directly from your company into your SIP for you to have it as a pension contribution from your company. Yes, Yuri?
Okay, sorry, I'm going to take you back a bit. So I'll use myself. I have a day job and I have a company. So can I then pay from my company into a SIP? Okay, thank you.
Let's say you're a contractor and your company has made 100,000 this year. And the company has paid you a salary of 12,000. Your company can also put 12,000 into a pension for you. And it's tax-free. Now, remember, once your company puts 12,000 into that pension, your company doesn't pay tax on that 12,000 because you put it in, is expensed before you have to pay tax. So it also reduces the tax that your company has to pay. So it's really good to always pay yourself a pension. You know that thing about paying yourself a salary first. So you pay yourself a pension as well from your company. It's very good. Yeah, somebody.
If she goes there.
She goes there.
Would you say it's advisable, like I opted out of pension, is it advisable to just open a SIP account and just invest yourself without like going back into pension with your company?
You work with a private company?
I work with the NHS. I opted out.
We opt back in Jesus' name. Why opt back in? You know why you opt back in? Because you are losing out on money. Because the government requires that anybody that's in a workplace pension, when you put in £2, employer too must put in £2. If you opt out, that money that you're supposed to put into your pension, that you need to eat biscuits, my dear, you will opt back in and collect your money. You are leaving money on the table. Go and collect that money. Because when they give you a salary, they will add it as part of your pay that they've paid you. But now, you have decided by yourself that you're dashing them your salary. Why? No. You will go back to your office and you will opt back into that pension that they have so that you will take advantage of the benefits that the company has to offer.
And it's okay for me to still open a SIP account too.
You can have a SIP in addition to your workplace pension. If you can afford it, go ahead and have a SIP. I always say, instead of a SIP, do a stocks and shares ISA because it's tax-free. Because your SIP is not tax-free. Your SIP is only 25% tax-free. So if you have that extra money, and it's not that a company is paying directly into your SIP, then go into your stocks and shares ISA. I will put money into my SIP. If, like Yori, I have a company that can pay directly into my SIP and can't give me the money anyway, then I will pay into that SIP. Otherwise, if you have money, use up your stocks and shares ISA allowance first. Does that make sense?
Thank you. Yes, thank you. It does.
Are you sure it makes sense? Are you sure? Because if it doesn't, I want you to ask me a question until it makes sense. Don't you, please?
Yeah, sorry, that's a quick one.
Yes.
Talking about if you have a company. So if I have a limited company,
yes,
I can now, even though I'm not getting paid for it because of the fear that I will be overtaxed because of my day job and the money coming from that. So instead of not taking money at all from my limited company, I can now I can be paying to my SIP from there.
No. Company paying to your SIP must be paying you a salary.
Right.
The company cannot afford to pay you a salary. Why are they affording a pension? So the HMRC has a common sense approach to this. So for example, there's no limit to how much your company can pay into your SIP. There's no limit. Yeah. But a company that pays you 12 grand a year cannot pay 100K into your SIP because it doesn't make sense. So if they could afford to pay you a salary, why are they not paying you a salary? If you're a minimum wage worker, why are they paying you 100K as a pension and pay you? Do you see where I'm going with this?
No, that's not what I'm saying. I'm saying if they can afford to pay me, but I'm not taking any money because the thought that if I take too much money from that account, based on my day job, I'll be overtaxed. I'll be paying too much tax at the end of the day.
As far as HMRC is concerned, the company is not paying you. It's because they can either not afford to pay you or you're not an employee.
No, I'm saying if I know that can I start taking money from my business now, then they will be paying pension, the SIP as well.
Company paying you a salary. If you take a salary from that company, then yes, the company pays into your SIP. Yes.
Okay.
Yes, but you need to be taking some income.
Okay.
Yes.
Right. Okay then. Thank you.
Ginger.
Can you hear me?
Yes, I think I should pause the recording because we are kind of talking. Right. So now we all know what platforms are available. You've had time to think about it. I'm going to give you 1 minute now to write in the chat what platforms you are planning to register with. In the list of platforms that you have, please write your platforms you are planning to register with there because I will be so that I can remind you or take notes if you have not registered in a few months. If you don't know, feel free to say you don't know, but I would prefer if you can tell me that you are going to be registering on a particular platform after this class. Now that you know what platform you are registering on and we know what kind of account you are going to open, it's going to be a stocks and shares ISA, a self-invested personal pension, or a lifetime stocks ISA. We are now going to go into what you can buy. What are the different assets that are available to you to buy when you have those platforms registered? Okay. Problem here is that the names I have for most of you are very different from the names that's showing up in your chat. Because Oluseyi, I'm not sure if that's Olu Williams or Olu Akinwale.
Hi, Ronke.
Hi.
Yeah, sorry. I just stepped out a bit, and I go back and I can see people are typing in some stuffs in the chat. What are we meant to do?
Yes, you are meant to tell me what platform you have decided that you are going to go for. Now that we talked about platforms, which you are planning to register on, so I can know what to shout about when I email you.
Okay, so I'm based in Canada, so we have Wealthify and Wealth Simple.
And Quest Trader as well.
And Quest Trader. Yeah, well, I've been to Quest Trader site before, and all the things they're saying there are just like jargons to me. So it's not kind of, should I say, user-friendly, maybe for a novice like some of us. So maybe I'll still try out Wealthify or Wealth Simple to see what it looks like.
All right. So yeah, Missy, are you moving from free trade to Vanguard? Is that the plan?
Yes, that's the plan.
Okay. See, I'm keeping track. I don't know what Tony is planning to register on. Who is iPhone? So I don't know who that is. There are two iPhones. I need to call names. Okay. So a lot of you are going for Vanguard. So perhaps I need to go back on Vanguard again so that we can see if Vanguard is going to make sense for all of us or what's happening there. Eunice, you asked about eToro. I haven't talked a lot about eToro because they also have a lot of trading activity there.
Yeah.
Which I find distracting. Maybe I'm easily distracted. Let's not talk about spectrums, but I'm easily distracted. And this is the only reason. So eToro as well is a good platform. Income?
Fidelity bond. Yeah.
Fidelity, okay. Please be aware that Fidelity also sells only its own product, very similar to Vanguard, but they have really good products as well, and their prices are usually low. Bola. I didn't get anything from Bola.
I'm just typing. I'm typing. I'm not
okay, you've not
decided. I'm considering a number of platforms, but yeah, I'm deciding.
Has been very quiet.
Yeah, okay. So
is Tunde going to tell me where he's going? Tunde and Toyi. Did I hear anything from Toyi?
Please, Income.
I'm confused. I have Income.
Income is speaking right now.
Sorry?
Income.
Yes, I have you. I have Income. Then I have an Oluwatoyin, separate from Income. Yes. So that means Oluwatoyin is missing. Interesting. Because I have Income Adeniran Adedokun. That's yes.
That's me.
Yes. So Bola is not decided. Do we have Tunde Karunwi in the house?
Yes. Hi. I have Vanguard before. I've been using Vanguard, so maybe I'll just try the Robo as well. Yeah. But currently I've got Vanguard. Yeah.
Okay. Somebody is on iPhone who's saying Vanguard and HL. Chikoze, you have your hand up. Please talk. Carry on.
You didn't say much about Moneybox.
Moneybox is super popular, and it is considered FCSC regulated as well. It's very popular, and there's nothing wrong with Moneybox. I just don't use it.
I registered with Emma. I don't know if it's also part of investing, but it has options for you to like invest on the platform. I don't know if you've heard of it, Emma.
Yes, Emma started out as a budgeting tool. I'm not a big fan. I'm not a big fan. With Moneybox, I feel like Moneybox is great for lifetime ISAs and for saving. And I feel the same way about Emma as well. I feel like these smaller platforms have limitations on what you can get from them. So Moneybox also has a stocks and shares ISA. But I'm just convinced that they have a very limited reach. And also, I think Moneybox is more of a robo-advisor. I don't know if anybody here has used Moneybox. Because Moneybox tells you to have options and they look at your risk level and they kind of choose your stocks for you. So, yeah. Okay. Yeah, it's very Gen Z. Okay. It's a robo-advisor. So we have everybody. You've confirmed where you are going. So let's look at the investment instruments that we're going to buy on these platforms. The first investing instrument that we're looking at is stocks and shares. This is the common one. Everybody talks about stocks. I talk about stocks a lot. And stocks are like, think of a pizza. A pizza is a circle. That pizza, the whole pizza, is the company, okay? That's the company that you're buying, that you're investing in. What's going on? Okay. It's the company that you're investing in. And when you buy the stocks of a company, you're getting a slice of that pizza. It's like, you know, I've ordered a big pepperoni pizza and I cut you a slice. So every time you take a slice of that company, of that pizza, you are getting a portion of that company. And the way to get a slice of companies is to buy them on the stock exchange. A lot of companies register on the stock exchange, and you can buy a portion of that pie on the stock exchange. Now, the price of the stock is influenced by different things: economy, industry trends, what's happening in the market, the performance of the company, aka Tesla with Elon Musk. Prices can be volatile. You know, so stocks generally have more risk than bonds, and I will tell you along the way why, but they generally are riskier than bonds, which is why your risk tolerance comes into play. If you're somebody who is able to take some level of risk, then stocks are good investment. And then you can get returns by dividends and by capital appreciation, which means you get dividends if the stock performs well at the end of the year. They will tell you we made profit and this is what we're giving our shareholders. And some companies will then say, actually, we're not going to give you anything yet. We haven't made enough profit, but you can get profits from dividends. And then over the years, the value of that stock can improve. So at the time you bought it, you could have paid £10 for that company to get a slice. And now that same slice, 10 years time down the line, is £100. And that is the main way shareholders make money, is through capital appreciation. You want the value of that slice of pizza to grow because there are limited number of slices. This pizza is delicious, and there are just 20 slices or 10 slices. So now, if you want to buy my slice, if you want me to hand over my slice to you, it's going to cost me a lot more than I got it because you really want that slice. So that's how capital appreciation happens for stocks. Now, there are different kinds of stocks you can buy. And people send me messages saying, Ronke, what stock should I buy? I can't tell you that, because a lot has to do with what your goal is. There are defensive stocks. These are the stocks of companies that are not affected by economic downturns. It doesn't matter what happens. They grow. They do well. Why? Because we need them. National grid. You don't say, oh, because we are broke, we're going to switch off all our lights. Or in winter, we're going to switch off it in 3 months. You will die. No matter what, even if you're wearing socks and cardigan, you must still switch on that heating. At some point, you will switch it on. Switch it off, switch it on, switch it off, switch it on. Use thermostat, you will switch it on. So they are a need. They provide a need. They meet a need. You're looking at Coca-Cola and thinking, how? They built a need over time. Tesco, do we all remember during COVID how we were buying tissue? Let me not say we. How some of you people were buying tissue. How much bread people were baking. How much we were stocking up the house with food. So when times are good, some companies thrive. When times are bad, those same companies, they will thrive. When COVID happened and we didn't have things to do and everybody was at home and times were bad, did people who need medication stop needing it? No. Did people stop having babies? No, they didn't stop. In fact, they had more babies because we were not jobless. We were jobless. We were not busy. So people were making COVID babies. So there are companies that will do really well. And these companies are called defensive companies. That's why you can see GlaxoSmithKline there, because they are pharmaceutical and people will need their mates. Now, there are companies called cyclical stocks, and these are tied to economic cycles. They experience fluctuations in line with the economy. When there is money and people are taking holidays, Booking.com will do well. Airplane companies will do well because they're cyclical. ITV will do well because people will watch more TV. You have time. Marks and Spencer will do well because you can buy clothes. You're buying more clothes. You can start shopping for food there because the economy is doing well. Retail outlets will do well. Designer brands will do well because they're cyclical, because the economy is doing well. The moment the economy is not doing well, we're all going to revert down back to the basics. We're going to revert to the things that we really need to have. And that is the stocks that are called defensive stocks. Now, growth stocks also exist. And they are the stocks of companies that are expected to grow in revenue and earnings over time at an above average rate because they are doing something that is trendy. something that is meeting a new need or an immediate need, or adding value to society in a way that we are all clamoring for. So an example of that is Amazon, Apple, Meta. We're all on Instagram, we're on Facebook, Alphabet, Google. We are all searching online, and the newest, sexiest baby on the block, NVIDIA, AMD, because they are semiconductor companies that make it possible for us to access new levels of data like ChatGPT and language models with the semiconductor tools that they provide. So when you want to buy a stock, it's beneficial to you to ask yourself if it's a defensive stock, if it's a cyclical stock, or if it's a growth stock, because it then influences how you invest in it, how much you invest in it, and how long you invest in it for. Now, I said earlier that stocks and shares are risky. They are riskier than bonds. Why? Because bonds are fixed income investments. At the time of investing in bonds, you know what you are going to get from it. Can we please switch on cameras? Cameras have gone off. 18 people in the room and there's only one camera on. Can we switch on cameras? I need to look at faces. Thank you, Yori. Thank you, Mwewa. It's good to see you again. Yes, thank you, Gwenga. Nice. I can see you. Thank you, guys. Yes, so bonds are fixed income investments. When you lend your money to an entity that has issued a bond, there is an agreement at the time of lending what your interest is going to be. That is why the risk is low. So if you buy the bond of a reliable entity, you already know at the beginning, what you are going to get at the end. There are no surprises. So you buy the bonds of reliable companies and countries. So bonds are usually issued by governments and huge corporations. So you can buy the bonds of the UK, which is called UK gilts. You can buy US bonds, they are called treasury bonds. You can buy German bonds. This means that you are lending money. So when you buy a bond, it's basically a loan. You are giving money, a loan to whoever's bond you buy. So if you like the face of the current government and you say, oh, yeah, Kama is looking like he can do things, I'm going to borrow him money, you can buy UK gilts. You can decide that you like whoever is coming to the US next when they get their president, and you can buy treasury bonds. But there are countries that have never defaulted on a bond, which means if you buy their bond, it has never defaulted. They've never come back and said, actually, we can't pay you. And I'm saying that because there are countries that will default. If you go to Africa and start buying the bonds of African countries up and down, you're on your own. But if you buy the bonds of countries like the UK, the US, and Germany, you are assured that you will get what you put in, what was promised you. Now, because of that, because there is a direct inverse relationship between risk and reward, your risk is low here. So your reward is low as well. So the UK gilt will tell you 1%. They'll tell you 1.2%. 1.5%, because you have chosen safety. You have chosen safety. So if you've chosen safety, you can expect your reward to be low. But if you are somebody who likes high risk, which is why I say your risk attitude matters. If you're somebody who is not too mindful of the ups and downs, then you will go for stocks, which can double your money and which can also take you down into lows that you did not expect. As of today, right now, my Tesla holding is at a minus 26% loss, which means my money right now in Tesla is 26% lower than what I put in. We thank the Lord. At the same time, I have funds like Summit Therapeutics, where my return right now is 207%. There are returns like that. I have Bailey Gifford China. He was doing great 3-4 years ago. Right now, my money is at minus 51%, which means I've lost half of the money that I have in there. Now, some people have sold it. They've taken their loss on the chain and they've said, I'm not interested in staying in this market anymore. I'm going to take my loss and go and put my money somewhere else. But that loss is not locked in until I sell. If I don't sell, there is potential for that 51% to come back. Once you sell, you have locked in the loss. You have accepted the loss. You have taken it on the chin. You have moved on. So that is where your risk tolerance comes in, is how much you can endure the loss while it's happening to you. Now, in addition to these bonds that I described, which I loan to the government, there's something called premium bonds. And I've talked about them on Instagram a lot. Is NS&I. When you put money into it, you are basically putting money into the UK government's savings account. They consider it the safest savings account that you can put money into in the UK. Probably in the world. It has survived 2 world wars. It's 100% protection backed by the government. You can put up to £50,000 in it. They don't pay any interest. That's how confident they are. They're telling you that your risk is zero, so your reward is zero. We are just saving the money for you. We are holding it for you. However, we will enter you into a lottery every month where you can win up to £1 million. You can also buy US Treasury bonds directly from the US government at treasurydirect.gov. With UK bonds, you can buy it from the UK Debt Management Office. You can also buy from some investment platform. AJ Bell will sell you UK bonds as well. But most platforms prefer to sell the exchange-traded funds of bonds instead of selling you the bonds directly. If you buy UK government bonds, which are sold on the bond market, and like I said, UK Debt Management Office or platforms like AJ Bell, if you see on the right, that's what it will look like when you want to buy it. They will tell you at the beginning, that 0.125% is exactly what interest they are planning to pay when the bond matures, which is crazy low. If you look at the next one is 1%, some 2.5%. I have one there that's paying 5% at the end of the maturity of the bonds, and the maturity date was 7th of March 2025. This thing was built, I think, 7th of March 2024. So it's showing you a whole year's worth. You're going to hold your money for a whole year and pay you 5% at the end of the year. You can get that from a savings account, from a high-yield savings account in the UK. So do I buy bonds a lot? No. At present, I don't buy bonds a lot. My financial plan at some point is to convert all my investment to bonds because it's 100% safe. And I don't want to lose money. By the time I'm 60, I don't want to lose any money anymore. I just want to be spending. I just want to be spending the money that I've made. Anything I've made up to that point, please, it does not need to grow anymore. I'm ready to just be spending. Now, some people might decide to keep investing till they're 60, 65, 70, but Warren Buffett is still investing. Hey, this guy has still balls of steel. That's not me. So you have to have a financial plan that then helps you decide what you put your money in, whether you want to do stocks, whether you want to do bonds, whether you want to do something else like mutual funds. Now, I mentioned earlier when we looked at Agri's Lansdowne platform, I said a lot of what they have in their wealth shortlist are mutual funds. And you're probably wondering, yeah, so what? What does that mean? Well, mutual funds are when, for example, Yori wants to buy the shares of Amazon. She also wants to buy NVIDIA. She also wants to buy Netflix. She wants to buy Microsoft. She wants to buy Apple. But Yori has just £1,000. Now, Yori's problem is Muiwa's problem, is Yemi's problem, is Fumi's problem, is Ayodeji's problem, is Chigoze's problem, it's my problem as well. We all want to buy the stocks of these fantastic companies, but we have just £1,000 each. So what do? We pull our £1,000 together. There are 19 of us in this room. Now we have £19,000. Then all of you, because you trust me, you hand over the money to me. And you say, okay, go with this £19,000 and buy all the shares that we want. And all of us, we now have equal shares, fractional shares of those things. So instead of me having a whole Netflix share, I will only have 1/19 or whatever it is that Ronke has bought. That is what mutual funds are. You pool your money, multiple investors pool their money into one portfolio so that the portfolio manager, who is called a fund manager, those boys in Canary Wharf, can manage it for you because you are not able to individually buy the things you want to buy. So they will buy it for you, and you can put your money into those funds anytime. And the aim of these fund managers is to get maximum return on your money. In exchange for that, they take a fee. In exchange for that, out of the £19,000, I will buy coffee and I'll take a taxi and I'll pay myself a little bit because I'm spending money, time, finding things for you. And that is why mutual funds have fees. They have something called management fees. And the management fees can sometimes be high, depending on the funds you have decided to put your money into. If you put your money into a popular fund, if you put your money into a fund that has historically done well, it's likely to have high fees because you're not the only person trying to get into it. And the managers, they live well. A lot of these funds, they will even tell you who the manager is. They will tell you the manager's name. Agri's Lansdowne will tell you the manager's name, what university he went to. A lot of them go to Cambridge and Oxford. They will tell you what university they went to. They will tell you he's based in Canary Wharf. He moved from this company. He has moved to this company because they want you to have trust in the person that's managing your money. You are more likely to hand over your £1,000 each in this group to me than to pack the money together and give it to Fumi, who is in Canada. Because you're going to say, I don't know him. I don't know where it's from. He doesn't have a following. I've not heard him talk about money, but you want to give that money to me because I have some sort of brand that you trust. And that is the way the fund managers themselves have very strong brands that you can trust and people know them and you give your money to them. However, there is a management fee. So if you decide to go for a mutual fund, it's important that you check who the fund manager is, their investing style, what fee are they going to charge, what is the diversity of the portfolio. Because if you give me your £90,000, and I had a thing for Elon Musk, and I put all your money into Tesla, and I don't tell you anything. And I'm just going, and you think your money is diversified because you wanted 10 different things, and I put all your money in Tesla, you're not going to be happy because you could have just put your £1,000 in the Tesla yourself. So it's important that you are checking the diversity of the portfolio when you look at a mutual fund and the underlying funds that are within that portfolio. Is it tracking an index? Is it following a particular industry? Is it technology? Is it pharma? Or is it mixing it up? What is in that portfolio? Now, there's an alternative to mutual funds, and this is the sexiest kind of fund that you can invest in. For me, I really love exchange traded funds. Why? They are doing everything a mutual fund is doing, which is pulling money into a basket and investing it in a multitude of things. But there is something different. There isn't a fund manager. It's automatically set up in a way that tracks a particular index. So instead of you having to say, instead of that manager deciding what they're going to put money into based on some research they've done, these funds are put into an index. And what is an index? An index is a measure that has been created to determine the performance of a sector, an industry, or an economy. So for the US is the S&P 500 index. That index has been set up to look at the biggest 500 companies by market capitalization and to use that to track the performance of the US economy. To say, if the US economy, if the S&P 500 companies are doing well, which are the top 500 companies in the US, then the US is either doing well or not doing well. So when you put your money into exchange-traded funds that's tracking such an index, your money is automatically invested in those 500 companies. It doesn't need a particular manager who's buying coffee and sitting in a room choosing the funds. And because of that, the fees are low. The fees are super low because there's nobody trying to constantly manage it. It's being passively managed. It's tracking an index. You know what your money is going into. It's the S&P 500 index. Then it's going into the largest 500 companies in the USA. If it was the UK, it would be the FTSE 100 or the FTSE 250, which means FTSE 100 is the top 100 companies in the UK by market capitalization. FTSE 250 is the top 250 companies in the UK by market capitalization. It's an index. Your money is tracking it, it's doing well. If it's a world index, it could be World MSCI, which is the one I love with the SWDA. It's tracking a set of companies that have been added to that index to track world economic performance. Now, these exchange-traded funds also have something else about them. They are traded on the stock exchange like the stocks of companies. They're so big, they're so well established. They're there, they're not managed by one guy sitting somewhere. They're on the stock exchange, which means you can buy and sell them in 5 minutes. With a mutual fund, when you want to sell your mutual fund, you request to sell it, your request is sent to the manager, who will then give you a price. Now, when they want to sell to you, they will say the last price that this mutual fund was sold, or the last price it was valued at, is 20 pounds. Are you willing to, what do you want to pay? You will say 21 pounds, or you will say 19 pounds, okay? If they get to the fund manager and he accepts your price, it will be sold. Then you will receive a notice saying it's been sold. And then you might receive a notice saying your sale or your purchase has been declined. So you see, there's a process. With the exchange-traded fund, is instant. If you mistakenly press on it, sold. Sold right now. As long as the stock market is open, you will sell your exchange-traded fund. So just like stocks, it's easy to sell, it's easy to buy. It also reflects, the performance reflects what is in the underlying asset or pot. The risk is what is in the underlying asset or pot. There are different types of exchange-traded funds. I said earlier, you could be tracking an index like the S&P 500 or the FTSE 100 or the World MSCI. You could also be tracking an industry. There could be an index that's tracking the performance of the oil sector. If you buy into that index, instead of buying just the shares of Shell or Chevron, I prefer to buy the index. So I buy an index that includes all of the top 10 oil companies, and I'm good. Now I'm invested in all of them with just £100. I don't need to start looking for £100 in 5 different places, which also helps me to avoid paying investment fees in 5 different places. Because when you buy an investment, you pay trading fees on a lot of platforms. And so instead of paying fees in 5 places, I pay my fee in 1 place. You can also do that for real estate investment trusts. You simply buy their ETF. It packs all of them into a basket for you, boom, you buy it, you go. I do that a lot. Now, in addition to buying stocks, bonds, mutual funds, and exchange-traded funds, you can also buy real estate investment trusts. Real estate investment trusts are companies that have been set up, and they are valid in the UK, in the US, and Canada, where you invest in real estate without owning the property direct. I'm a very lazy investor. When it comes to property investment, I mean, start talking about boiler has spoiled, this one has spoiled, landlord come and open the door, landlord come and do the gate, landlord, I'm tired. I'm tired. How much are you paying me? I'm waking up for Saturday morning. Auntie, come and move out. I'm a lazy investor. I don't want that. Am I a landlord right now? Yes. Do I like it? No, I don't. Because there's a lot of work that goes into it and the return isn't great. But if I do real estate investment trust, for example, and I invest in residential real estate investment trust, they probably own 50 properties. It means they have an in-house carpenter, in-house plumber, in-house electrician who charges 10p, £1 per call out. Why? Because economies of scale. Because the carpenter is servicing 50 properties. Carpenter is happy to charge them less. But you, with your single property, when you buy real estate, the carpenter will charge you premium. You want me to go to your single property in Kent to go and look at their boilers, £250 on Saturday. There is a leak. They've opened the pump, the thing under the tap. The water is flowing. You will go. So you save money when you invest in real estate investment trusts because they have economies of scale and they can own properties that you by yourself cannot afford to own. Some of them are invested in NHS hospitals. Some of them are invested in retail malls. Some of them are just malls that you can just invest your money in and they go on and they have all these properties. Canary Wharf is owned by real estate investment trusts. Excuse me, you can choose to invest in them and suddenly you are a part of that real estate investment trust journey. You're a part of it, you own those properties along with them. It also allows you to invest outside your immediate environment. So for example, I want to invest in real estate, but I want to do it in China, or I want to do it in Canada, or I want to do it in the US. I can't go there and own property. It's cumbersome, it's difficult, it's stressful, but I can do it through a real estate investment trust. By just buying into that real estate investment trust, I can buy into their portfolio, I can do the healthcare one, I can do industrial facilities, warehouses. You can even do infrastructure real estate, where you're owning telecommunication towers, wireless infrastructure, office buildings. All of that exposure is there for you when you invest in REITs. Commodities. This is another kind of investment. You can buy gold. Physical goods, add commodities, gold, silver, soft commodities, agricultural products, you can buy them. They are also traded on commodity exchanges. You can buy gold in bullion bars. If you're interested in bullion bars, I know somebody who sells gold in bullion bars and she's trustworthy in the UK and she can sell you gold in bullion bars. Prices are also volatile. They are influenced by the economies. It's a tangible asset with intrinsic value. Now, why do I like gold? Women, we like shiny things. We like shiny things. It's how we are made. Now, instead of you buying costume jewelry, I will always say buy gold. Buy gold. It has retail value. Whether you're buying billion bars or whether you're buying gold jewelry, buy gold. Because it's a physical commodity that edges against the stock market. When the stock market is not doing well, that is when gold does well the most. Every time the stock market dips is when gold rises. So it makes it a good edge investment. So it's a good way to diversify your portfolio. And I think it's one of those kind of assets that we don't give a lot of respect to, but it's actually a good investment. It doesn't grow suddenly, but it has its resale value. It moves, it grows your money over time. When I got married, my mom passed on some gold jewelry to me and said it was from my grandmother. And when I got it, it was ugly. Listen, this was ugly gold. Like I would not be caught dead wearing that gold. It was ugly. And I was a little bit put off that, this is old school gold now. Nobody is going to wear this kind of, what is this? Until I took it to Dubai. I was praying for my grandmother. I was thinking, I'm a Magba. You're not doing bad at all. What a lovely lady. And that is the benefit of gold. It is there. It is tangible asset. it has resale value. So you can opt for gold. Now, if you don't want to buy physical gold, you don't want to buy bullion gold, you can still buy gold as a stock commodity. So there are companies that are gold companies that are quoted on the stock exchange, that when you buy them, they're indirectly investing in gold. And when they do well, when gold does well, your stock will also do well. So you, as a person, if you're a guy, you don't necessarily have to buy gold directly as an asset. You can choose to buy gold as a stock asset. Now that we've gone through a few assets, the key assets that you can buy, I'm going to give you 2 minutes to write in the chat section what assets you are considering to buy after this conversation, because we are going to take action. And I'm not going to let you guys go off and then forget about it. What assets would you consider based on your knowledge of your personality, of your knowledge of your financial goals, which you know? What are the assets that you would like to buy? Let's take a minute to write that in the comment section. Okay. I'm seeing ETFs and REITs. Yes, REIT and gold. Fantastic. Okay. All right. Thank you very much for your responses. Just looking at it, I can already see your risk appetite being reflected in your choices. Thank you, guys. I'm really glad that you have taken a moment to consider yourself, your interests, and your goals before making these choices. I'm really glad to see this. Benga, you have a question?
Yes, I do. I just want to ask, I don't know, maybe you are aware of about the Revolut Bank.
Yes.
You can also trade there, which
yes.
I'm not sure about it because I have an account with them as well, but
Okay.
I knew that you can trade there and every stuff like that, but I haven't done anything there yet because I'm not sure of the trading over there. I don't know how it works over there. So I don't know, maybe you have an idea about it. Thank you.
So what you need to do is to check if they are FSCS regulated. So I try not to have opinions on individual platforms because there are a gazillion platforms out there. I want you to be able to litmus check platforms yourself. So you need to ask, is it FSCS regulated? If I go to the FSCS website and I type in their name, will Revolut come up? Most likely, because I've heard of Revolut, it's a big platform. But I want you to do that check. Now, you also need to check, do you want to trade? Is that what you want? No, I want to invest. Do they have the tax efficient accounts that I need? Do they have a stocks and shares ISA? Is that what I need? Do I need them for a SIP? Do I need them for a lifetime ISA? Which one do they have? If they have the accounts that you need, am I happy with their fees? Do they sell the assets I have chosen in this list? If you have chosen REITs and you have chosen ETFs or you have chosen mutual funds, do they have them? Make sure that now that we know what you want to buy, you've used your hand to write it here now. Check the platform that you have chosen. Do they have these things? Do they invest in these things? Do they allow you to invest in these things on that platform? That is how you will decide which platform you want to go for. Yeah, if Revolut is the one for you.
All right, thank you.
Let me just add quickly that they've changed the law around platforms. In previous years, up to last year, you could only open one platform per year. If you have a platform and you've put money into it, you can't put money in another platform in that same year. They have now removed that rule. So you can have money in one platform and put money in another platform in the same year. So if you check Revolut and you find that it's not what you want, you don't have to wait till April 6, 2025 to open a new account. You can open a new account today and move money into it and start investing through that account. You can also transfer the one you already have into it, or you can leave it there and just have a new one entirely. Okay, so we know what commodities are. These are not investment. This is the part where you and I will fight. These things are not investments. They might be good for your mental well-being. They might be good for your desire to reward yourself. They might improve your quality of life. You know, if you are somebody who drives long distances, you might really need a strong car that can move fast, that can let you rest your back. I like good cars. If you see me in my Range Rover tomorrow, or you see me in my G-Wagon, please don't drag my shirt. Please. Don't look at me and start shouting, coach, coach, coach. And you in a Range Rover, I will fight you. Because I did not call it an investment for you. It's not an investment. Some of you saw me in Croatia and you started shouting, come on, your holiday. Did I say you can't take holidays? You can't take holidays. I didn't call you my holiday an investment to you. That's the difference. Some people, see me. Somebody saw me one day entering a luxury store. She followed me. She followed me. And then she said, stand there. Let me take your... No. Confess now. I love wearing Hugo Boss. I love some designer brands. I love them. It does not change the fact that they are not investments. I like to enjoy my life the same way you like to enjoy your life. What I'm trying to encourage here is for you not to think of them as investments, so that you don't put the bulk of your money into them, so that you don't do them before you invest. No, we earn our money, we save, we invest, and then we live large. That is the order in which we do things. So once you have put aside your investing money, you've put aside the money that you need for your pension. Now you know what you have to spend on your house renovation so that you can buy that red bathtub. So that you can know what you want to use, what you have to put into buying that luxury car. So that you can know what you're spending when you are buying that Bose electronics, or you're buying your Bang & Olufsen TV. You know what you're spending money on. It's very important that you realize that these things are not investments. Now, some of these things are not investments, but some of them I will completely discourage. Timeshare properties, I am here to discourage timeshare properties. Please don't allow anybody to encourage you to own a part of an apartment in Spain that you can stay in, and when you're not staying there, you are collecting Airbnb. It's a lie. It's a lie. When it's summer period, when you want to go and stay there, they will tell you that you don't own enough to stay there, or they rented it out. In the winter, when there's nobody there, and even you don't have all the days to go there, they will tell you that this is the time you should come and stay there. I know people who own timeshare properties, and it has not gone well for them. So on this list, that is the one item I would discourage. Luxury cars, do it as your income allows. It's not an investment. Enjoy your nice bags, even though they've told us now that, is it Dior or Gucci that is spending $25 to create the bag they're sending to us for $5,000. God will judge them. Hell is hot. But now you know what is an investment and what is not an investment, so that you can bear it in mind as you're buying that pot. Exam time. Which investing instrument is a loan to the government? Unmute yourself.
Bond.
Bond, thank you.
Yeah.
Now that I've answered one question, you're not allowed to answer any other question. This instrument is managed by professionals and may have fees.
Mutual funds.
Who's that? Who answered? Thank you. Mutual funds, yes. I can see from Taiwo also answered that question. You can buy these investments in physical form.
Gold.
Gold. Gold. Thank you very much. Amazing people. Thank you very much. I'm glad because it shows me that you are listening. I will take you back a little bit. One question: why should you invest?
So mitigate against
wealth.
inflation.
No, if you have answered the question, you can't answer again.
Oh, okay.
The guys who are
wealth
at all, why should you invest?
To make your money work?
Yes, to make your money work.
Growing money.
Grow your money.
Grow your money. Passive income.
Inflation.
Security.
And financial goals.
To meet your financial goals. Okay. I need somebody to give me the names of 4 different assets that you can buy on those platforms that we talked about. It needs to be somebody who has not answered anything before in this test we are doing right now.
Stocks and shares, ISA.
And you are giving me joint group answer. I like that. No, you're no excuse. Who answered that one?
I did.
Kenny did. Oh.
Okay. Stocks and shares. What else?
Gold.
Gold. What else?
Self-invested.
Lifetime
personal
ISA.
pension.
Lifetime ISA.
Assets. Who said lifetime ISA?
LISA is an account.
Yeah, ISA is
LISA is an
Lifetime
account.
ISA, just start up.
Tax-free account.
Rates.
We have stocks and shares, yes. We have gold, yes. What else can you buy?
Bonds.
Bonds, yes.
Rates there.
Yes, thank you very much.
Yes.
Those are 4 assets. Those are 4 assets that you can buy. You can tell me the name of 2 tax-efficient accounts.
LISA, stocks
Yes.
and shares, ISA.
Sorry?
Stocks and shares, ISA.
You've answered the question before.
yeah.
EFT.
For me, TFSA, yes.
ETFs.
ETFs.
ECF.
No.
I said tax-efficient account. I didn't say assets. Tax-efficient account. Chigozie.
Oh,
SSP.
Yes, RRSSA. Yes, thank you very much. So now I know that you guys have listened in this class. You understand what you are supposed to do. The 6 steps we are going through is that we are going to open an account on an investing platform. You have all confirmed to me what investing platforms you are going to open your account on, except Bola, who is still thinking about it. You have not escaped. You will get an email. Then you will choose your tax-efficient account, which can be a stocks and shares ISA, a SIP, or a lifetime ISA. Then you are going to choose the kind of investment you want. You've all confirmed you are buying either REITs, ETFs, gold, mutual funds, or stocks. And now that you've chosen the kind of accounts you are going to buy, you are going to go ahead and pick the specific types of accounts, the specific type of assets you are going to buy, individual assets that you are going to buy. I will show you a cheat sheet of some of my favorite assets, but we'll get to that. Now, remember I said earlier, you need to know your risk appetite. You need to assess your comfort level with risk, understand it before you invest. You need to know your capacity to invest. Don't invest your rent and your mortgage money. So which means you need a budget. You need to be investing what you have saved. You need to be investing after you have put aside money for your bills. You take out your savings and investing on your budget the same way you have put money aside for bills is how you put money aside for your investment. You need to have clear investment goals, clear what you are investing for. Are you investing to grow wealth? Are you investing for your pension like me? Are you investing for your children's education? Are you investing to buy a house? You need to know what your goals are. Muiwa has a question.
Okay, thank you so much for your time so far. I think my key question is, you open, for example, you open a LISA, you open a stocks and shares ISA, so you have the account, you put money in, right, for that. Now, I'm trying to just juxtapose that with buying these assets, right? You know, when you buy these assets on these platforms, you know, where do the returns go into? Will it be, because I'm thinking of the, like when you start getting the returns, is it going to be in your own accounts, like your own personal accounts in terms of how you get the returns? Or because I'm looking at the tax, because you say stocks and shares is tax-free and all that, these returns, is it different? It will be different from the stocks and shares, am I correct? And then
stocks are tax-free. They are not required to declare or report your returns. So when your stocks, if you sell your stocks, they will just pay the money back into your they will tell you that your money is now cash in your account.
Right.
Would you like to transfer it to your bank? We transfer it.
Right.
They pay you dividends. It will show in your account that you have cash.
Yeah.
You can invest your dividends or you can transfer it out.
Right.
If it's not dividend, if you have bought a stock that is accumulating or an ETF that's accumulating, I will show you what that means. Your money is automatically reinvested.
Okay.
So whatever you get from your stocks and shares ISA is nobody's business. Even if that money doubles and triples, it's nobody's business. You will sell your assets and you will be able to just take your money out into your bank. I wanted to go back to the 6 steps at the beginning so that we can look at it and see that we have covered those 6 steps. Yes. So these are the 6 steps. We choose the platform. We open a tax-efficient account. We've chosen our preferred investment. You place your order. This is why I said if you put money into that account, you will have to make sure you are buying something. You have to see that you have bought something. They will tell you that this is what you own. These are the units that you own in it. And this is how much you paid for it. You need to see that you have bought something. You can either buy one-off or you can set up a direct debit so that monthly, that money that is entering monthly is being invested. So first of all, there's a direct debit for the money to enter.
Yeah.
Then there's a direct debit that the money that has entered is now being invested. Rinse and repeat. There is no magic to it. It's very straightforward. You log in, you manage your own account yourself. Chigozie, you have a question for me.
Just to be clear, so the stocks and shares, bonds, ETFs, they are all under stocks and share ISA, right?
Say that again.
Like the bonds, the ETFs, commodities, they are all under the stocks and share ISA, right?
And buy them under that account. So once you register on the platform and you open that account and you load money, the money will be sitting in your stocks and shares ISA account, from which you can then buy ETFs, bonds, REITs. Now, anything you buy from that account is tax-free. That money, the purchase, the return on it, if you sell it, if you get a dividend, any activity you execute from within your stocks and shares ISA is tax-free. Now, if you make the mistake of opening a general account or a fund and share account or a basic account, when you invest, HMRC is watching, they don't see anything. Then in 5 or 7 years, God will bless you. The money will double. As you are selling it, the platform is reporting. You yourself, you'll be required to now fill a self tax return. Then HMRC will collect tax on it based on your income at that time. You want to avoid all that scenario. You want to avoid all that activity by simply investing through your stocks and shares ISA. Now, I need to share these key points with you. We are running out of time. You need to do your research. Information is out there. I can't tell you everything. You need to do your research. You need to assess your risk before you invest. You need to make consistent investment. Why? Because the market is volatile. The market does this. If you invest only once in a while, you might end up investing when the market is like this. Then when it goes like this, you are not investing. You are running away. By the time you come back and you are ready again, the market is like this again, you are buying. Then you run away again. Then by the time you come back, so you keep buying high. But if you're somebody who is investing regularly, you will buy here, 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 you will buy at different points, and your investments will level out. Diversify your portfolio. I'm telling you this now, nobody knows tomorrow. Please, the moment you meet any Instagram influencer, financial activist, financial volunteer, financial magician, financial brother in the Lord, and they are telling you that they know what will happen tomorrow, just heels to the back of your head, be running, because they're about to collect everything you have. Nobody knows. None of us predicted COVID. That is why you diversify your portfolio. You invest wide. I'm very happy that you guys chose ETFs. Almost everybody here chose ETFs. The people that didn't choose ETFs chose gold. It means you are edging. You are buying more than one thing. Nobody here chose one item. I love that. You are diversifying your portfolio. Make sure that you are diversifying your portfolio. Your dividends are not taxable within your stocks and shares ISA. The overall sale is not subject to capital gains tax. As long as it's within your stocks and shares ISA, it is not subject to anything. You don't report it. You don't talk about it. You collect it. Yeah, it's gone. But if you do it through your general account or your fund and share account, yes, it will be taxable. Yes, it will be open to dividend allowance and then tax after dividend. It's not just that. You must report it as as extra income in addition to whatever income you have. And yes, the sale will be open to capital gains tax. And that is what you want to avoid by using your stocks and shares ISA and your lifetime ISA and your SIP to invest. So like I said before, use your tax wrappers. Take note of the financial year. It's April 6 to April 5. Different companies pay out dividends at different points. Everybody doesn't pay out dividends at the same time. They declare their profits. That is when they decide when they are going to pay out dividends. You will see it when they pay it out. They would give you a notice that you received a dividend. And you will be able to see your dividends. Build your emergency pot. I have somebody who messaged me yesterday to say she has an emergency. Now she wants to sell all her investment. And the first thing I said to her was, what happened to your emergency pot? The way to avoid selling your investments when you are in need is for you to have an emergency pot. Your emergency pot should be money that you can live on for 2 or 3 months of the year. I cannot overemphasize the emergency fund. The emergency fund gives you privilege. It gives you confidence to change jobs because you're not afraid. It gives you confidence to dust your CV when your manager is moving mad. And if you're in this room and you're not pitch colored, your manager will move mad. They always move mad. So if you have 3 months pay slip, they move mad, you change jobs. You need a break from your job because of your mental well-being, you can take it because you have that emergency fund. It allows you to not touch your investment so that you can leave it for 3 to 5 years or even 10 years and allow it to double and you get compound interest. And that's when you put in increases in value. And then the interest also increases in value, and the interest of your interest is earning interest. That is what grows your money. That is what will take £300 to £300,000. It's not just because you are earning one-off interest. It's not just 5%, which is why when I do a video and somebody says, so it's just 7% per annum. I can get better from somewhere else. You are ignoring compound interest. I can see your hand that's raised. I will attend to you. I just want to run through this slide very quickly before I take questions. Don't forget to make pension and retirement plans. If you are not part of the pension, workplace pension, jump on it. If you are self-employed, get a SIP, get a private pension. Pension B has a private pension, or you can do the one you invest yourself, or you can do a private pension with like Pension B or Aviva, where they give you a fixed setup portfolio. Whatever you do, please have life insurance, especially if you have children. Life insurance is key. Health insurance is the difference between we caught the cancer at stage 1 and it is now stage 4, say goodbye. So please get health insurance. People over the age of 40, please get health insurance. NHS is not enough. They're overcrowded, they're overworked, they're tired. There's not enough people to run that system. Appointments are not on time. And I'm touching all of these things because it's important to me that as we are building financial wealth, that you are around to spend it and that you are able to spend it in good health. Understand your cash flow so that you are putting in money that you are able to invest as much as you can. It's important that you invest aggressively before your 55th birthday. I don't want you calling me when you are 55 to say, Ronke, can I now make 1 million? Ronke, what do I need to throw in every month? No. Investing is not about how much you put in. It's about time. If somebody is doing £100 monthly, they are much better than the person that does 5,000 at the end of the year. Do your £100 monthly or £200 monthly and stay consistent. Chigozie.
When you spoke about multiple platforms, does that mean like now if I have a Vanguard account and let's say Moneybox, I can invest stocks and shares here and I can invest ETFs here and then invest in bonds in the other platform? Is that possible?
It is. But you need to ask yourself why you are jumping about.
Okay.
Yes. I have stocks and shares account in 2 places. And my reason is simply, I've had one before for a long time. It's a lot of fees. And the other one is charging me lower fees. And they sell the same things. So I went to the second one. I kept both accounts. Why? Sometimes the second account moves mad. I want to log in. I can't log in. They are down. They are doing works. What is that? The more expensive account is never down. 24/7. They are there for me. So you need to know why you are having multiple accounts. If you already had one account and you find it not user-friendly or distracting, or you don't have what you want and you move it, that's absolutely fine. But make sure you're not just opening accounts up and down because you will lose track of your money. So you need to be careful to not have 3 or 4 stocks and shares account just because you can.
Okay.
Yeah. Okay. I have 3 hands up. Ayodeji.
Okay. Ronke, thank you so much. You've been so helpful. But I want to ask something. You said something about the cap for what you can have in all these accounts as £20,000. So, okay, I've opened an account now. I put a direct debit. I'm investing. I'm doing everything. But when my investment goes above £20,000, what happens?
To inform HMRC because you have decided to get into a dealership with them. So you will get into the dealership.
Oh.
When you want to set your direct debit, divide 20,000 into 12 parts.
Okay.
So you try and do 1,600. If you do 1,600, you will not exceed the allowance. If you do a direct debit of £2,000, by your 10th month, you have reached 20. 11 months, you will get to 22. Then you will open the affair with HMRC because that is what you now want.
Okay, so let's say in a year, I invest up to £20,000. what now happens after that first year? Does it mean the second year I can't keep on investing or something? Because I don't understand it. That's why I'm asking this question.
Second year, you get a fresh 20,000.
So the first 20,000 that I have now, okay, let's say I've maxed out the 20,000, I've gotten my interest, whatever it is. I've moved. Do I have to move it into my own personal account now?
You don't have to. It continues to grow. So that in the second year, you can have another 20,000 added to it.
Oh, okay, so the 20,000 cap is for 1 year.
It's for 1 year.
Oh, okay, so it's like for one financial year, kind of.
I have stocks and shares accounts where I have over 50,000.
Oh, okay.
I just keep moving it in. And then because I know that my allowance, the maximum that's protected is 85,000. Once I get to 85,000, there's nothing you can do in this world. I will go somewhere else. Because I know that if anything happens to your company, I cannot get more than 85,000.
Oh, okay, so I can now open an account in different whatever as.
Yes.
Okay.
Always open an account in different platforms. You just cannot open this account in the same year.
Okay.
So let's say this year now, the account this is the way it worked before they made it free for all. If I have an account with Lansdowne this year, and then 3 months into the account, I find that I don't like them, I have to stay with them to the end of that year.
Okay.
Then the new year, with my new allowance, I can go somewhere else. The money in Agrips, I don't even have to move it.
Okay.
It just means they will not get more money from me.
Okay.
That money you have, continue to grow that one for me. Then I will go to another place and start a new 20,000.
Oh, okay.
If at the end of that second year, those people too, I don't like them again, I will go to another one.
But you leave the 20,000 there with them.
We leave it.
Okay.
I'm not obliged to move it.
Move it, okay.
And if I move it, as long as I don't withdraw it before moving it, I don't go and sell everything, and then carry my cash to the new platform. If I do a direct transfer from an old platform to a new one, it doesn't even affect the new allowance because they are aware that it's an old allowance that was used.
Okay. Sorry. Thank you so much.
You're welcome. Doing.
All right, sorry. Can you give us some companies that give dividends, good dividends?
A lot of defensive stocks pay dividends.
Okay.
A company called Parker Hannifin. Parker Hannifin has paid dividends every year for 63 years.
Okay.
There are companies like that. I used to have a list of companies. I'm going to try and see if I don't have the list anymore. I used to have a list of companies here that I would share and to just show people what I've invested in the past. But I found that people took pictures and ran off to start doing all, and then they come back to me a week later to say, the thing you asked us to buy. No, I didn't ask you to buy anything. So I don't give that list here anymore. But I can tell you 1 or 2 things that I invest in. So when you think of, okay, I'm going to leave this website now, and I'm going to go to Agrips. Now, if you come here and you type in, yes, the FTSE 100. For example, the FTSE 100 is the 100 largest companies in the UK. You can see their names here. This is a good list of thriving companies to invest in. I will look at them individually and look at their performance and invest in these companies. That's one approach. You can look at the FTSE 100 companies. The other approach is to find a top ETF. Now, stay with me. ETFs, like I said before, they are a basket of funds, and some of them have some really solid performances. The S&P 500 is a fund, is an index that's tracked by a lot of, how do I call it now? Tracked by a lot of ETFs, yes. So the Vanguard has a very popular index called the VUSA, which is an index that is passively managed and is invested in the S&P 500. What is the S&P 500? The 500 largest companies in the US. You can see the performance of the VUSA in 1 year. And that's it in 3 years. Now, in 5 years, the VUSA has doubled the money from £40 to £80. That's a really strong performance. In 10 years, the VUSA has tripled your money. So if you had put in 25,000 in 2014 in the VUSA, you would have 75,000 now. Some people just put all their money in the VUSA and they keep it moving. Why? Because they automatically invest their money in the top 500 companies. Now, sometimes what I do is look at the top 10 exposures of that ETF and put my money in it. Because these are the companies that this ETF ranks as the top 10 of the 500 companies in the US to invest in. Then I look at these companies, I do my research, and I invest in them. Am I invested in all of these 10 companies? Yes, I am. Individually, I am, but also as part of an ETF, I'm also invested in them. There are so many ways you can invest in, find the companies you want to invest in, Yahoo Finance is a big one for me that I use to look at companies. And then I can also say you should also look at to understand what kind of companies that you can invest in, to look at their dividends, their performance, and so on. Some of the companies I look at, you might find a bit intimidating, but I will share with you anyway. Stock analysis is a platform that I like a lot. If I go into stock analysis and I type in the company, it would give me all the statistics about the company. What is their 52-week range, which is the lowest price they have sold in the last 52 weeks, last 1 year, and the highest price. What are the analysts calling it? The analysts are right now saying Microsoft is a strong buy. They're saying if you have money, buy Microsoft. Some companies, you will type into this place and stock analysis analysts will tell you, please don't buy it. So right now, I don't know why it's showing me AT&T is just a buy. But if I put in, say, Tesla, is Tesla a buy? It's a hold. It's saying if you already have Tesla like me, hold it. If you don't have Tesla, this is not the time to buy Tesla. They are saying that this is what analysts are saying. You can go further and look at their financials. How have they done in the last year? Why are they asking you to hold it? What are the statistics about it? What are the stock price? What are the dividends yield? Tesla has not paid dividend yield to anybody. Anybody. And this is very common with growth companies. They don't pay dividend yield. They will tell you that they are still growing. They are using your money to grow. Please be calming down. We are using your money for now. If you can live with it, you can go there. Now, if you type in a company like National Grid, when I was talking earlier about defensive stocks, look at their dividend per share. These are established masters. These people don't have time to tell you they are growing. They have already grown. They've grown. There is profit to be made. So you are the one that will decide what you want from the companies that you are invested in. I've kept Fumi waiting for a while. Fumi, can you ask your question?
Thank you.
All right, thanks, Ronke. I was actually waiting that you're going to mention something, and thank God you did, which is about life insurance, right? So now we've talked about, stocks and shares, ETFs, even commodities in terms of gold and the likes. And what actually resonates with me, because I've been in talks with some couple of financial advisors of late, and some of them have actually mentioned or talked about life insurance. And life insurance, not just only having a life insurance as a means of protection, right? But also as a form of investment, kind of. And then the investment aspect of the life insurance, which I want you to talk about, is the cash surrender value aspect of life insurance. Some people go into life insurance that has a cash surrender value, which is maybe at a certain point in time in their life, maybe by the time they get to that retirement age, all the contributions that they've done into the life insurance at a certain time, by the time they get to the retirement age, they can take a certain part of it, at least just for them to still maintain their lifestyle till whenever they eventually want to go. And the life insurance itself will still be in place, even when they die, for their beneficiaries, So I want you to just just shed more light in that regards as to the cash surrender value. Is it still a very good form of investment compared to all these other type of investments that we've talked about?
Okay, so life insurance as an investment is a thing only in the US and Canada. Life insurance is not an investment in the UK. We don't have that option. Now, cash surrender value in Canada is the money that you as a policyholder can receive if you decide you're not doing again. If you decide to terminate or surrender your life insurance policy before death, which means you want to benefit from it by yourself, they will give you the money minus any fees or any loans that you have taken. The other thing about cash surrender value is that it provides you liquidity. If you need money tomorrow, you can take a loan against your cash surrender value. You can take a loan. And that's the benefit of life insurance in the US and Canada. In the UK, if you terminate your life insurance, you just terminated it. There's nothing. There's nothing. There's no payout. There's nothing. You've lost it. Now, at the time you take out cash surrender from your life insurance, you have lost the death benefit. So if you terminate your policy and take your cash because you need money, you have surrendered that policy, you lose the benefit. And there might even be tax implications on whatever gain has been made so far. But if you take a loan against it, you have not lost the policy. You have simply taken a loan against your cash surrender value. So that is what is different about life insurance in Canada. Now, life insurance in Canada and in the US can be a sort of forced saving plan. Because if you are putting money into it, you are actually building that cash surrender value. Does that make sense? So you are putting money into it. It's forcing you, because once you enter it, you have to pay it. It's not something that you are optional. This month I will contribute. No. You are contributing into your life insurance. I will encourage you to do it, because unlike the UK, if you decide that you need money in future, you can terminate. Now, the cash value of that money also grows without tax, and it can be tax-free for your beneficiaries. It is possible. It allows you to do estate planning, because then you know that your beneficiaries can get a lump sum that can cover any issues that they have after that. And you at some point might also decide that, you know what, my next of kin, they are not behaving well. I'm taking my money. Or my next of kin are doing very well, they don't need this money. So permanent life insurance, they are more expensive, but they allow you to have that cash surrender that provides liquidity, and you can take some of it, you can take a loan against it, and all of that. So in Canada and in the US, life insurance is considered an investment. Term life insurance is not an investment, because it's coverage for a specific period, 10 to 20 years. If you die within that period, you get money. If you are still alive, it has expired, there is no payout. So term life insurance is what we have in the UK. Permanent life insurance is something that you have in the US and Canada, and you're able to have that cash surrender value for yourself.
Thank you very much. Thanks.
I have one hand up, and then we have to close out the class. It's been a fantastic day with you guys. Is it doing? I can see one hand up.
No, but that was a mistake. I put it down. Thank you.
All right, thank you. All right, so thank you very much, guys, for attending my Investing Masterclass.
Sorry, Ronke, before you close out, you were going to share a cheat sheet, and I think Olu's put that in the comment as well.
So that was the cheat sheet I said I don't have in the deck anymore, because people come back later on to tell me that, oh, I told them to invest in this thing. I don't give any more cheat sheets in class. Yes, I remember that was it. Yeah, so apologies for that.
Sorry, Ronke, quick one.
Yes.
Based on properties, is it good to have your property in your personal names or limited company? Sorry, just a good one. You understand?
So that's an interesting one. So if you have just one property, then having it in your name makes sense, because there's no tax to be paid. Because if you put it in a company, then then you have to start doing returns on that company, declaring if you have a profit. It becomes company property. You know, it's open to debtors, it's open to a lot of things. So if it's one property, then yes, in your name. But if you are investing in property, it's always better to do it through a limited company in the UK.
Ronke, sorry, I read somewhere that for inheritance purposes for your children and things like that, that it is better you hold your properties in like a trust instead of being in your company name or your personal name.
Yes.
I don't know how that works in UK, but I read it somewhere that it's that way your children won't have to pay inheritance tax or something on the property.
It's more of a US thing. The UK is very efficient when it comes to inheritance tax. There is trust opportunities in the UK as well. However, I am not an expert on that, and so I cannot speak on it. But please explore that with a estate planning agent or financial advisor. They'll be able to tell you a lot more about it.
Thank you. Thank you so much.
You're welcome. Yes, the pension consolidation one you have to do with pension providers. So I've just realized now the pension providers consolidate for you, but you can use the pension tracing service to find your pensions, which is what the details I shared in the chat, and then you can use whatever platform you want to then consolidate on to consolidate. So once you choose a platform where you're putting your pension, then the consolidation will happen through that platform. Okay, so thank you everyone for attending the class. I'm going to stop sharing my screen. I'm also going to stop recording so that